We're testing main digital recorder. We're testing the main digital recorder. Testing, testing main digital recorder. Testing main digital recorder. Testing, testing.
Ladies and gentlemen, can you please take your seats? Good morning. As the MREC designated federal officer and acting chair of this committee, it's my pleasure to call this meeting to order.
I'm going to take a quick second to acknowledge the chairman to make some remarks before we begin the regular order of the business.
Thank you. As we all know, we lost a great American leader over the weekend. George Herbert Walker Bush was the President of the United States and a great leader who served in wartime. On his 18th birthday, enlisted in military service and served with distinction. Became an entrepreneur and then entered into a lifetime of public service as a congressman, as the head of the CIA, as American ambassador to the United Nations and to China, and also as vice president for 2 terms and president of the United States. He entered into service not to exert power over the lives of others, but to serve the lives of others. In his memory, the federal government will be closed tomorrow. This agency will be closed. Many of our markets will be closed, and we will just have a small staff to provide surveillance of the markets that remain open, but otherwise will be closed. But I'd like to just call us all to just recognize a moment of service for the loss of an American leader, if we can. Thank you.
Before we begin this morning's discussion, I would like to turn to the members of the commission for opening remarks. We will start with Commissioner Berkovitz, followed by Commissioner Stump, then Chairman Giancarlo, and finally Commissioner Ralston Benham, the MREC sponsor. Commissioner Quintenz could not be with us today. However, he sends his regards, and his remarks can be found on the commission's website. Now we will have remarks from Commissioner Berkovitz.
Thank you. I would like to thank in advance all of the participants in today's meeting for contributing to the discussion, and Commissioner Benham and Alicia Lewis for sponsoring and putting together this morning's meeting. I want to briefly mention my interest in 2 topics that will be discussed today: clearinghouse risk management and the treatment of derivatives exposures and margin under prudential regulator rules. First, clearinghouse risk generally. Clearinghouse risk management is a critical issue for the CFTC. After the adoption of the Dodd-Frank Act, substantially more activity, both in swaps and futures, is now centrally cleared. I believe wholeheartedly that encouraging central clearing is good for our markets and market participants. Central clearing mitigates systemic risk. However, with the expansion of the volumes of trade cleared, we need to be ever more vigilant in monitoring and overseeing clearinghouse risk management. A big part of that effort is having opportunities like this meeting to discuss with market participants the clearing risk management and governance issues on today's agenda. A few words also about the capital treatment for derivatives exposures. During the last public meeting of the Commission, I expressed concern that market concentration in fewer entities can have negative effects on competition and systemic risk. It is well known that FCM services are becoming more and more concentrated. A large majority of futures and swaps are now cleared by a handful of FCMs affiliated with large banks. The document recently released by the FSB on incentives to centrally clear OTC derivatives states that, quote, across the United States, the United Kingdom, and Japan, the amount of cleared client trading activity which passes through the top 5 clearing members exceeds 80% for IRS as measured by notional value. The FSB also reports that the current treatment of margin posted by clients in the leverage ratio may be a significant disincentive for FCMs to offer or expand client clearing. I'm very much aware of the concerns around bank leverage and support efforts to restrict excessive risk-taking by banks. However, a reduction in the availability of clearing services offered by fewer firms could itself become a risk issue. This would not be a good outcome. In considering measures to reduce risk in one area, we must ensure that we are not creating or exacerbating risks in another area. Accordingly, I look forward to the discussion today of current proposals by prudential regulators to revise the calculation of derivatives exposures for bank capital rules. Thank you.
Thank you, Commissioner Berkovitz. Commissioner Stump?
Good morning. Thank you to Commissioner Benham and Alicia Lewis and to all of the members of the committee for putting together this very thoughtful program. I also want to commend Commissioner Benham for his leadership in reviewing the critical transition to the alternative reference rates. And I look forward to working with the newly established subcommittee on interest rate benchmark reform. This work is timely and essential to the orderly functioning of our financial markets, and I look forward to their work. Additionally, the important role of clearinghouses in our financial system is undeniable, and we rely on them, and most often I think we as regulators talk about the risk that they help our market participants deal with in the form of counterparty credit risk. But the performance of this fundamental market service is often the subject of our debates, and I look forward today to talking about a bit more about the clearinghouse infrastructure risk. From settlement bank and custodian bank failures to cybersecurity and the use of third-party service providers, what standards guide the management of those risks, and who bears those risks and over what time horizon? I think these are important questions, and the Commission needs to be fully briefed and aware of how those things are being managed today and if more needs to be done going forward. I'm also looking forward to continuing our review of our regulatory efforts. You all have probably heard me state that I consider this to be the most critical element of the G20 reforms, that we constantly reassess and determine if our regulations are fit for the purpose they were intended. So I look forward to hearing from many of you regarding the recent reports of the global standard setting bodies and the proposals from other regulators. The topics we discussed today are closely tied to this Commission's mission of fostering open, transparent, competitive, and financially sound markets. I want to thank all of the presenters today, and I look forward to your presentations.
Thank you, Commissioner Stump. Chairman Giancarlo?
Thank you very much, Alicia. My thanks to Commissioner Benham for holding this meeting on these important topics, and I also want to thank you, Alicia Lewis, and the Commission staff and presenters that are here today on these panels. And I share Commissioner Stump's recognition of Commissioner Benham's focus on benchmark reform, which is a very, very important topic for all of us. Over the past several years, there's been substantial progress on ensuring the safety and soundness of swap central counterparties, especially on recovery planning. Nevertheless, there is still more to do, in particular on resolution planning. The size and scope and complexity of CCPs has increased, as has the importance of effective risk management and governance. It's important that we continue to have an ongoing conversation with CCPs and their members regarding these important issues of risk management and governance. And I share Commissioner Berkovitz's concern for concentration of clearing services, indeed other services as well in our cleared swaps markets. This MRAC continues to have an important role in facilitating this very important dialogue. The analog to digital switch in financial markets happened, the changeover to digital in financial markets happened years ago and continues today, and the CFTC needs to keep pace with this rapid digitization of our markets. Market participants and registrants have moved away from a bricks and mortar world and are moving towards outsourcing their infrastructure, and so it is apt to think about these changes as well. One of the challenges of regulation in a digital world, it is built on registration and direct oversight of market participants and registrants. As more outsourcing of critical components occurs, what does that mean for that model of regulation? It's a timely topic, and I thank you for bringing us here today to discuss it further. I look forward to the conversation today.
Thank you, Chairman Giancarlo. Commissioner Benham?
Good morning, and welcome to the MRAC's third and final meeting of 2018.
As we have edged closer to a new year, I've begun to reflect on the work of this committee that started 12 months ago, and I'm both proud of the accomplishments and equally optimistic and excited for 2019. As our markets continue to grow, evolve, and innovate in an atmosphere of increasing geopolitical tensions, there will be new questions and issues to address. This committee continually demonstrates a deft ability to adapt itself by addressing the most pressing and challenging market risk issues of the day. I want to thank Chairman Giancarlo, Commissioners Stump and Berkovitz for being here today and for their contributions to this discussion. We have a full day ahead, including the introduction of the newly formed Interest Rate Benchmark Reform Subcommittee. I want to thank and acknowledge the MRAC members who volunteered to moderate the panels today. I also want to thank each of the speakers for their willingness to travel to DC during the holiday season and contribute to this important conversation. I want to thank the Commission staff who will be speaking today, some of whom have also traveled to be here. And I'd also like to thank Margie Yates, her team, and all of the Commission staff who work behind the scenes to make these meetings come alive and run smoothly. Finally, I'd like to thank Alicia Lewis, the committee's DFO, 3 meetings deep in a short 12 months, and Alicia keeps core logistics running smoothly and helps formulate and shapes topics, issues, and discussions that make all of the MRAC meetings so valuable and insightful. Today's agenda begins with Tom Whiff, Vice Chairman of Institutional Securities at Morgan Stanley, and our newly appointed Chairman of the Interest Rate Benchmark Reform Subcommittee. Thanks in part to Tom's participation, the last meeting of the MRAC in July introduced benchmark reform as a key topic of interest, not only to MRAC members, but also to anyone who has a car, small business loan, student loan, mortgage, or credit card. As highlighted by Chairman Giancarlo in remarks last week at the 2018 Financial Stability Conference, despite huge improvements in the governance process to produce LIBOR, the market for unsecured interbank term lending that underlies LIBOR has dried up, and the regulatory mandate compelling LIBOR submissions has an expiration date. Fortunately, there are coordinated initiatives underway specifically targeted at addressing the myriad of impending issues related to the derivatives market. Chief among these initiatives is the Alternative Reference Rate Committee, which is tasked with leading and directing the transition away from LIBOR to SOFR, the secured overnight financing rate. At the MRAC's July meeting, 3 panels focused on the role of interest rate benchmarks in the economy, the impetus for LIBOR reform and the current status of global reform initiatives, the development of SOFR and SOFR derivatives, and the impact of LIBOR reform on legacy derivatives contracts, the development of fallback language, and key risk management and governance considerations for market participants. Following the meeting, the Commission voted to establish the Interest Rate Benchmark Reform Subcommittee to provide reports and recommendations to the MRAC regarding efforts to transition to U.S. dollar derivatives and related contracts to SOFR and the impact of such transition on the derivatives markets. I was overwhelmed by the number of highly qualified nominations to the subcommittee, and it certainly was difficult to make selections. I strive to ensure that the membership represents a diversity of viewpoints, and I believe the final 21 individuals chosen to serve will participate actively and engage one another as they develop and work towards the subcommittee's goals and objectives. Tom will kick off today by reporting on the subcommittee's first initiatives. My goal is to use the subcommittee to complement the work of the ARC by providing additional insight into the potential challenges leading up to 2021 and the end of compelled LIBOR, identifying the risks for financial markets and individual consumers, and above all else, providing solutions within the derivative space. I've spoken publicly on this issue several times since July in various forums, and I intend to continue to engage as wide an audience as possible to ensure that market participants, both business and legal, the global regulatory community, lawmakers, and the general public are aware of the impending issues and timelines, and know that I am available as needed on any matters that will serve to navigate to a smooth transition. With that said, I want to recognize and thank Tom for his willingness to serve in the important leadership role as subcommittee chairman. And finally, I want to thank Chairman Giancarlo for his continued support of this endeavor. The chairman and I are in lockstep, and I am confident the subcommittee's work will produce deliverables that will be extremely valuable to the Commission and ultimately global financial markets. Turning to the primary issue of today's MRAC, one of the core reforms outlined in the 2009 G20 Pittsburgh Accord involved mandatory clearing of standardized swaps. The Congress embraced this reform in Title VII of the Dodd-Frank Wall Street Reform and Consumer Protection Act, and the CFTC subsequently finalized a series of rules defining the clearing mandate. Since March 2013, the clearing mandate has led to a tectonic shift in the swaps marketplace. According to data collected by the CFTC on U.S. reporting entities, by 2017, about 85% of new interest rate swaps and credit default swaps were being cleared. The numbers speak for themselves, and I certainly believe, and I know that I am not alone in this, there will always be room for improvement, and that we can all strive to set policy and market practices to further incentivize clearing where appropriate. As the financial crisis taught us, central clearing works. While the unregulated OTC swaps market played a role in the credit crisis, the exchange-traded futures books of major financial institutions proved resilient, in part because of central clearing. Today's discussion will largely focus on topics and issues raised by MRAC members related to clearing and the roles and responsibilities of CCPs in monitoring and managing the variety of risks arising from stresses, including, but not limited to, a clearing member default. The CFTC, along with its international counterparts, is continually confronting the challenge of building and maintaining the appropriate regulatory framework for clearing in and among a population of CCPs with unique risk profiles that will withstand routine shocks and demonstrate resiliency in crises. As the financial crisis also taught us, we must cooperate and provide predictability while remaining flexible in our approach to ensure the response is appropriate when addressing an actual crisis. As well, we must constantly examine and evaluate whether our rules effectively and appropriately allocate duties and burdens in and among CCPs, exchanges, intermediaries, and market participants. Today's panels aim to highlight how CCPs currently approach their duty to engage in strong risk management amidst our current regulatory landscape, and how global and domestic standard-setting bodies are analyzing our current structures in support of making any necessary changes. Our first panel, facilitated by Robert Steigerwald from the Federal Reserve Bank of Chicago, will set the stage by providing an overview of current risk management and governance issues with a focus on the appropriate balancing of interests and incentives between the clearinghouse and its members, as well as a consideration of clearing member and customer viewpoints. In our second panel, we will examine management approaches to non-default losses generally, as well as in recovery and resolution, and some of the scenarios in which they may arise. One such scenario could involve a cybersecurity breach that creates non-default losses. Cybersecurity as an operational risk issue is a concern that has been voiced by many on this committee, and as newer, faster, and more pervasive technology permeates our market infrastructure, the chance of a successful cyber attack will likely increase. If such an event occurred and caused losses at the CCP, should those losses be met from available CCP capital and other CCP assets, or should they be socialized amongst the clearing members, or partially covered by both? The answers to these questions will likely depend on the CCP itself, but by having the conversation about how these losses can be dealt with, we will be in a position to better understand how to react when an operational, investment, or custodial risk becomes a reality, particularly when non-default losses occur as a part of the same event as default losses. In our third panel, we will discuss some of the most recent relevant reports from global standard-setting bodies on the costs and incentives of clearing and the resiliency, recovery, and resolution of CCPs. 8 years after the first reforms were implemented, the accumulated data can be used to evaluate the effectiveness of the G20 clearing mandate and related reform-based initiatives. Many of these reforms have proven effective by moving risk from the over-the-counter derivatives away from the unobserved fringes of our financial markets and towards monitored institutions that conduct central clearing and data reporting. This move has facilitated greater transparency into market risks and provided increased netting efficiencies. As the reports have shown, however, these benefits have not come without costs, and there remain concerns regarding whether the regulatory structure properly accounts for risk in terms of capital, margin, and leverage. Our last panel of the day will introduce a new topic for MRAC and cover the oversight of third-party service providers and vendor risk management. Exchanges, clearinghouses, intermediaries, commission registrants, and their customers employ a wide array of vendors that provide a myriad of different services, and each relationship carries its own risk. As all of these entities continue to increase the number and complexity of relationships with vendors through the outsourcing of businesses and regulatory compliance functions, registrants must ensure that they have appropriate management and control functions to address the associated risks. At the heart of those relationships is the ability of market participants to know with whom they are doing business, both directly and indirectly, and what risks may arise from third-party service providers. During this panel, we will hear from the Office of the Comptroller of the Currency, whose bulletin on the risk management of third-party relationships is considered among many to be the eminent guidance on sound risk management across a variety of relationships. We will also hear from a principal provider of services in our market and from our own supervisory staff as we explore the current regulatory guidance and tools at our disposal to evaluate, monitor, and manage these risks, and consider whether the Commission's current regulatory scheme works to mitigate risks posed to market participants by third-party service providers. It's my intention that this afternoon's panel discussion on risks related to vendor relationships will be the start of a longer conversation by this committee and potentially a subcommittee, with the ultimate goal of providing the Commission with surgical recommendations as needed to ensure market safety, transparency, and resiliency. As Chairman Giancarlo noted last week, market reform is a continuous, iterative process that requires constant and consistent communication, coordination, engagement, and evaluation. As I have noted before, we cannot observe the current strength of the financial markets and expansiveness of the regulatory landscape and conclude that our job is done, or worse, that we can dial back our efforts under the guise of excess. We must all remain vigilant and not limit our focus on the looming shadow of systemic risk to the tools that we have. We must examine all of the components in our systems and go beyond assessing and assigning a metric of risk. We must strive to understand and actively monitor and manage the risk of each component at every system level and in every connection. As the risk footprints change or lead in different directions, our goal must be to respond through adaptation in our management and regulatory responses. In the international clearing space, we have an interconnected, highly concentrated system comprised of other interconnected, somewhat less concentrated systems. This is all governed by regulations held together by consensus-based principles aimed at preserving and strengthening financial stability. Within that structure, the points of potential default and larger catastrophic failure are too numerous and many too remote to account for. Nevertheless, we must persist in our analysis and participate in coordinated efforts to better understand, better inform, and better address risks in all its forms. This committee is among those efforts, and its ongoing operation and input contributes to our ongoing processes. Very excited about our agenda for today and want to again recognize the tremendous amount of work that has gone into planning this meeting and thank everyone for being here.
Thank you, Commissioner Benham. Before we begin, I would like to do a roll call of the members that are on the phone so that we have your presence on the record. After I say your name, please indicate your presence. Operator, please give the individuals that have been cited as having speaking rights the ability to indicate their presence. Matthias Graulich, Eurex Clearing.
Yes, I'm present.
Sebastian Kohling, Optiver.
Yes, I'm present.
John Murphy, Commodity Markets Council.
Present.
Jonathan Rafe, Nomura.
Present.
Tomas Philippon.
Yes, I'm here.
Rana Yared, Goldman Sachs.
Hi, good morning.
Thank you. Just a few logistical reminders before moving forward with the agenda. Committee members and panelists, please make sure your microphone is on when you speak. The meeting is being simultaneously webcast, and it is important that your microphone is on so that the webcast audience can hear you. Also, please lean in to the microphone when you speak and keep your phones away from the console because we get feedback. Members, if you'd like to be recognized during the discussion, please change the position of your place card so that it sits vertically on the table, or raise your hand, and either I or the panel's facilitator will recognize you and give you the floor. Members on the phone, we will give you an opportunity to ask questions or make comments either at the beginning or end of our discussions. As Commissioner Benham stated, our first order of business today will be a report from the MRAC's Interest Rate Benchmark Reform Subcommittee. As you may recall, as Commissioner Benham said, at our July meeting, the MRAC voted to recommend to the Commission to establish a LIBOR subcommittee. The subcommittee has been established and held its first meeting recently. Tom Whiff, we ask that you bring the report of the subcommittee.
Thank you, and good morning, everyone. Appreciate the opportunity to present again in front of the Market Risk Advisory Committee on behalf of our newly formed Subcommittee on Interest Rate Benchmark Reform. For those who haven't met, my name is Tom Whiff, Vice Chairman of Institutional Securities at Morgan Stanley. I additionally represent our firm on the Fed's Alternative Reference Rate Committee and the board of ISDA. And before we begin, I have to say that my views are not representative of the ARC or Morgan Stanley, and they are my own. I want to also take a moment to thank Commissioner Benham, Alicia Lewis, this committee, the MRAC, the rest of the CFTC for forming this subcommittee. Additionally, thank you to Commissioner Berkovitz, Commissioner Stump, and Chair Giancarlo for the opportunity to present these the results of our organizational meeting to you today. The transition to alternative reference rate is a major challenge ahead of us. And for us to achieve success, it is paramount that we have close coordination between the public and private sector. I also want to thank, before we get rolling, the other members of the subcommittee. Their names have been announced today. They're in your packets. In the interest of time, I think if people just want to take a look at them. But what I will tell you is, as you read the names, you will see that this is a very well qualified group of participants from all parts of the market. And I can certainly report that from our first meeting, there's no hesitation for people to want to get on with this work. So our organizational meeting was quite active, and I think that we're making progress right out of the chute. I'd like to begin the discussion by just recalling a bit from our July MRAC meeting, and that resulted in the creation of this subcommittee. So back on July 12th, we moderated a panel in front of MRAC that covered several different important areas regarding the transition to alternative benchmark rates in the U.S. During that panel, we discussed an overview of LIBOR reform, latest developments with LIBOR, SOFR derivatives, and the effect of LIBOR reform on the derivatives industry. We heard from industry experts who have been instrumental in raising awareness and moving the ball forward on LIBOR reform as it relates to their institutions, their clients, and their counterparties. At the conclusion of that committee meeting, the MRAC voted to form a subcommittee on interest rate benchmark reform and to provide reports and recommendations to the MRAC on the effect of current LIBOR reform initiatives on the derivatives markets. Since that MRAC meeting, there have been several material updates to LIBOR reform around the globe. In the U.S., market participants are working to create and implement fallback language that can be used in newly issued cash products. We are also working actively to use the new rates available for derivative contracts in the form of SOFR futures and SOFR swaps. In the UK, large banks and insurance companies are working to complete their Dear CEO letter ahead of this month's deadline. In Europe, a replacement benchmark rate has been selected, and market participants are forming their transition plan ahead of the deadline imposed by the EU benchmark regulation. Market participants globally are focused on the preliminary results of ISDA's market consultation on fallback calculation methodology for derivative contracts. Although USD LIBOR was not in scope for this particular consultation, the results of the consultation are still viewed as significant for U.S. market participants, as they may provide an indication how the eventual ISDA protocol for USD LIBOR fallback methodology is calculated. With the formalization of the subcommittee's membership this morning, we are now hard at work to identify areas of the LIBOR transition in which we can provide input and recommendations to the MRAC and to the Commission. In charting our intended contribution to the MRAC and broader CFTC, the subcommittee has defined our areas of focus and the boundaries of our work. The ultimate goal of our subcommittee on interest rate benchmark reform is to provide input and recommendations to the MRAC as it relates to potential policy changes that may impact the course of LIBOR reform. Our key principles our first principles that we put forward is, one, we aim to remove hurdles to the transition to SOFR. Two, we aim to suggest incentives for market participants to transition to SOFR. And we aim to accomplish all that while avoiding any inadvertent creation of a safe harbor and policy changes that would create any activity that was away from the transition to new rates. The deliverables that our subcommittee presents to MRAC will be detailed, specific, and actionable in nature. Further, our intention is to submit these proposals and recommendations to the MRAC within a reasonable amount of time, based on certainly the group that's been assembled here. The list of things we need to do is fairly straightforward. We want to put work streams behind that and get things moving fairly quickly. In forming our recommendations, we are mindful that our duty is to the broader market and not to individual institutions. Apart from providing proposals to the MRAC, the subcommittee also recognizes that it has a responsibility to continue to raise awareness of the reference rate transition among market participants. As we move through this, we've really described this as we are entering sort of the second act of a three-act play. For the last 4 or 5 years, there's been a lot of work on understanding the issues, on educating market participants, on spreading basically the word around what it means to transition, what are some of the vulnerabilities to the current LIBOR, and then moving things forward. As we sort of enter this phase now, we are seeing things that actionable, things that can take place. We see very close to having a fallback for derivatives. We have over $20 billion in cash market issuance, floating rate notes using SOFR. We're seeing activity in both swaps and futures. So there are things that are happening now, and I think as we move to sort of phase 3, that will be the final implementation that we see as we approach 2021. We also believe that meaningful progress between now and then will make for a much smoother transition, and that will be a focus of this group as well. Given the collective expertise and the reach of the members of the subcommittee, we really want to strive to be a force for good as the broader market prepares for LIBOR reform. In selecting the members of the subcommittee, it is clear that the intentions were to capture a large cross-section of the market in order to maximize the committee's ability to create awareness and to track our progress in a meaningful way, and to ensure that all participants in the market are heard from in this process. The subcommittee includes members from asset managers, clearinghouses, end users, exchanges, intermediaries, market makers, service providers, CEFs, and trade associations. In carrying out our mandate, we are also mindful of the finite scope and boundaries of the work. Specifically, the subcommittee is limiting its focus to policies and recommendations involving the U.S. derivatives market. We will work within these boundaries in order to provide actionable and policy-driven input to the MRAC. This is consistent with the mission of the CFTC and the spirit in which the subcommittee was created. Next steps. In light of our focused approach and a desire to provide input to the MRAC within a reasonable time frame, the subcommittee at our organizational meeting has already charted out a plan of attack to accomplish the goals. Last week, we had an introductory phone call to discuss the mandate, to set our first principles, and the remit of the committee. As a starting point, we're going to leverage the work that was done by the ARC in its letter to the U.S. regulators dated July 12, 2018. In this letter, the ARC and member firms requested specific interagency guidance regarding the treatment under regulations pursuant to Title VII of Dodd-Frank Wall Street Reform and Consumer Protection Act of existing derivatives contracts that are amended to include new fallbacks or otherwise reference alternative risk-free reference benchmarks and new derivative contracts that reference RFRs. The proposals we ultimately provide will be additive to this letter, not repetitive. It is of top priority that the policy-based recommendations that we make to MRAC will not inadvertently create loopholes or safe harbors that go against MRAC's primary goals for the subcommittee. By the end of this month, the subcommittee will gather and circulate internally thoughts on regulation in the U.S. derivatives markets that could potentially be refined in order to encourage the transition to SOFR. As a result of our initial subcommittee call last week, we are already hard at work in this regard. We will meet in January and on a monthly basis thereafter to further discuss and collaborate in an effort to deliver meaningful and actionable results to the MRAC. We aim to provide MRAC with substantial update on our progress at the meeting, following each meeting, and we plan to memorialize our work very clearly to ensure that there is a body of work behind these recommendations that will articulate clearly the design, the reasoning, and the approach that the committee has taken prior to making any recommendations back to this committee. Our objective is to be helpful to the MRAC and the broader CFTC as you further implement strategy to facilitate and encourage a transition to SOFR in the U.S. derivatives market. We applaud the MRAC and the CFTC for prioritizing this important issue and being front-footed with regards to executing the reference rate transition successfully. The creation of this subcommittee, as well as recent comments from Chairman Giancarlo, are evidence that the transition to alternative reference rates has been appropriately prioritized here. Once again, I would like to thank Commissioner Benham, Alicia Lewis, and MRAC for this opportunity to present. The subcommittee is intently focused on creating actionable recommendations to further the market's progress as it relates to the transition to alternative reference rates. We strive to be additive to other sources of market progress, remain focused on the scope, and remain well connected to the work that's happening outside this group, and ensure that we are synced up very well. We welcome feedback from the MRAC on the principles that we've set forth, the three first principles that we described, and we look for feedback on anything we've discussed here today. With that concludes my prepared remarks, and I will pass it back to Alicia to solicit any questions from the room, comments, feedback, or criticism.
At this time, I would like to open the floor to questions or comments from the MRAC membership. Thank you, Tom.
Tom,
Chairman Giancarlo.
thank you. Thank you very much for that. It gives me a great sense of confidence and optimism that the subcommittee will bring to the attention of the MRAC and through the commission, if there's anything that we're not doing that we should be doing, which is very helpful. Is there anything that outside of the CFTC and our fellow U.S. regulators can be doing to help? And I think you made the point about really getting the word out. Is there anything more that can be done to get the word out really into the heartland?
Yes, I think I can certainly say, and for folks around this table and folks who will be on the subcommittee, it's really clear that when we have these discussions, I think at our individual firms, and we speak to large groups of clients or individual groups of clients, what we're finding is that there's a wide variety of where people are in this evolution. So clearly, when we speak to large institutions, there are programs in place. People are doing the things that they need to do to get this transition organized and so forth. But then we find, infrequent users of the derivatives markets or infrequent issuers who are much less focused on this. So, I think that, this really is going to involve pretty much everyone in the market grabbing an oar anywhere they can. We are finding that just getting out and getting the information out there, but clearly, the CFTC is extremely well positioned in this area to educate and to push this forward. And I think that from our view on this, having been with the ARC since its inception, the first couple of years has really been just identifying, getting people to take a hard look at LIBOR, look at the vulnerabilities, and think about how to transition to the new rates. With the rates available, with some activity in the cash markets, with activity in derivatives markets, I think it is a continued education, but certainly to get well beyond the large institutions who clearly are focused on this, to get deeper into the markets, the users there. I think the CFTC is extremely well positioned on this, and we would look for any support on that to just continue to just educate, push forward. And really, I think as the calendar turns to 2019, 2021 doesn't seem that far away anymore. So the more we can do to move things forward, the more certainly your supportive comments and the supportive comments that we've heard from the public sector has been extremely helpful, and the more of that to raise awareness, the better, and anything else on the table to kind of push this forward. We do find in every one of our broader client meetings that the spectrum ranges from we're just hearing of this to we're absolutely rolling along with a full program. So anything we can do to fill those gaps, anything you can do to fill those gaps would be greatly appreciated, I'm sure, by this subcommittee and its members.
Thanks, Tom. As I've shared with you and with Commissioner Benham and others, I think the word is out in the London, New York, Washington corridor. My worry is the word is not out in Kansas City and in Atlanta and in Dallas and elsewhere. I know the ARC has recently been in continental Europe speaking to lending institutions there, but we need to get ARC in front of lenders across this wonderful country to speak to small lenders, home builders, others that extend credit in the markets that rely on LIBOR, that the days of LIBOR are numbered, and that SOFR is on its way. And we need to get that word out. We need to find a way and a means to get ARC activated across the country.
I couldn't agree more, sir. I think what we have is an opportunity. I think as Sandy O'Connor, chair of the ARC, has put it, it's like we're not running from LIBOR, we're sort of running to SOFR. And I think getting people around that idea that there is an existing set of risks that we all share, that there's a collective action that needs to take place to actually move this forward. This is a reference rate that was created by the market and has to be repaired by the market. So as we take this forward, any of those opportunities to take this into the heartland will be greatly appreciated. I would also suggest that, like members of the ARC, members of our subcommittee will be asked at their own individual firms to continue to be, to sort of be preaching this as well and making sure that this information is working its way through their systems to their clients and so forth. So the more each of these committees can instill in their membership, a general requirement and the spirit of this to get out there and sort of continue to spread the word among their clients and counterparties, the better we can do. And certainly, as I said before, I think the CFTC is extremely well positioned to provide a lot of support there.
Well, Commissioner Benham, you have great experience in taking the show on the road, conducting advisory committee in Kansas City next year. Maybe we can have MRAC committee meetings elsewhere in the country to help spread the word on LIBOR.
Thanks, Chairman, and thanks, Tom. And couldn't agree with you more. Like I said in my statement, we are in lockstep, and we will continue to take advice from you, Tom, for certain, but also have an interchange that I think we can all benefit from to make sure that folks across the country learn about this.
Thank you. I'd like to recognize Stephen Berger, Citadel.
First off, I'd like to thank the Commission and the MRAC for focusing on this important topic, and thank you, Tom, for leading the efforts here. Just one kind of comment and observation from our perspective. We think that as liquidity starts to build in swaps referencing SOFR and other risk-free rates, it's important that we build it within the open, competitive, and transparent clearing and trading framework that we've all worked so hard over the last 5+ years to build for swaps referencing LIBOR. Otherwise, we fear that this very much needed transition to sounder risk-free reference rates and derivatives referencing those rates could be accompanied by at least a pause or some steps backwards in terms of market stability and integrity. As things stand now, the Commission's reporting rules in Part 43 and 45 by default already apply to the new activity that's occurring in swaps referencing SOFR, and I think that's been quite valuable in the nascent stages as we've been able to observe the activity that is starting to occur in the swaps market, and we also have data obviously on what's happening in the futures market, and data is being compiled on what cash issuance is occurring that references SOFR. So being able to look at all three of those products in a transparent fashion, I think, is very helpful to market participants as they begin to think about transitioning their own activity into products that reference SOFR. By contrast, as it stands now, the Commission's, and this is obviously probably appropriate in the nascent stage we're in, but as it stands now, the Commission's clearing and trading requirements do not by default apply to swaps referencing SOFR. With respect to clearing, that would require a clearing determination to be made in the form of a rule proposal, and then on the heels of that, it potentially would take a SEF, at least under the status quo, to make a match determination. So I'm not saying either of those things need to happen today by any means, and from the data we've seen, it appears that the vast majority of activity in SOFR swaps is already happening on a voluntary basis in a cleared environment. But I think at least our hope and aspiration for the subcommittee is that we would have a thoughtful but forward-leaning set of recommendations that will solve the very collective action problem you mentioned, so that as we build this new liquidity pool, we do it again in a way that benefits from the sound framework we've already established for LIBOR swaps.
Yeah, I think when we discuss that and we lay that against the sort of the first principles we've laid out, I think that that's certainly a topic that the committee should be looking at. I think if we think about the idea that to remove obstacles, to create incentives, and to avoid inadvertent safe harbor outcomes, I think that certainly that we'll take that on board and we'll have those discussions.
The chair recognizes Jim Shanahan, CoBank.
I'd like to thank the commission for putting the emphasis on the benchmark reform. It's something that the Farm Credit Banks are significantly significant users of LIBOR to our lending, and one of the things is that we have really done a lot of outreach to the financial institutions we finance, because we want to encourage the market to start thinking about the resources and systems that are going to be touched by this aspect. And I do think it's a great aspect that you guys are going to come out to Kansas City, hold another meeting. It was a very productive meeting last year, and outreach. We're doing a lot of education with our customers right now, just to convince them this isn't another game to harvest value out of them, and let them know that this is an enhancement and not a punitive step. And there's just a lot of education, and I encourage you guys to speak on this every chance you get. Thank you.
Thank you, Jim. Anyone else? Are there any members on the phone that have questions or comments?
Not from me.
Well, if not, thank you, Tom, and the members of the subcommittee. We look forward to hearing more about the subcommittee's efforts at the next meeting. And for all of you in the audience, the list of subcommittee members is also on the agenda table, and the press release was issued earlier this morning. Okay, so now we'll start our discussions on clearinghouse and vendor risk management.
Thank you very much.
Thank you, Tom. Our first panel discussion will be on clearinghouse risk management and governance today. I ask that the facilitator and speakers come forward and take their seats at the panelist table. You do not need your tent cards. And the facilitator, Bob Steigerwald, you come sit by me. As Commissioner Benham stated earlier, Robert Steigerwald will facilitate and help shape the discussion during the panel. Robert Steigerwald is a senior policy advisor for financial markets in the Federal Reserve Bank of Chicago's Economic Research Department, where his work focuses on public policy issues relating to financial market infrastructure. He also formerly represented the Federal Reserve Bank of Chicago and the OTC Derivatives Regulators Forum, an international forum for information sharing and regulatory cooperation among central banks, prudential supervisors, and market regulators with respect to clearing and settlement arrangements and trade data repositories for OTC derivatives. Mr. Steigerwald is a graduate of the State University of New York at Stony Brook with a BA and the University of San Francisco School of Law with a JD. And he's also a member of the MRAC. So we are very happy that he has volunteered to facilitate today's panel. And I will turn it over to Bob.
Thank you very much, Alicia. Thank you, Commissioner Benham, for giving me the privilege of leading this very important conversation this morning. Before we get to the business of this panel, just a reminder, Alicia wants to make sure that we follow the rules of good participation in the conversation using our microphones. Turn them on, please, when you are speaking, and turn them off when you have finished speaking. Also, as before and throughout this meeting, you may enter the conversation by raising your name tent to a vertical position, and you will be recognized by the chair. And I hope that I will use my own good example of speaking loudly and clearly so that the folks on the other end of the line can hear us as an example to all of you. In the event that I should say anything novel or noteworthy, much less controversial today, it is incumbent upon me to issue the standard Fed disclaimer that my remarks are solely my own and not those of the Federal Reserve Bank of Chicago or the Board of Governors of the Federal Reserve System. It's not my intention to do any of those things, but sometimes things slip out. So, just a few remarks to frame the issue to be discussed in this panel. We are, of course, tasked with discussing CCP governance as well as risk management policies and practices. And this is quite a full set of issues that are both distinct at times and that blur into each other at other times. Governance, I think, can be thought of in both a broad and a narrow sense. Broadly speaking, governance can include the role of public regulators overseeing CCPs as well as their members. It can also include the internal governance arrangements, rule setting, supervision, market surveillance that takes place within a CCP. And of course, in a more narrow, traditional sense, there are the very thorny issues of corporate governance that are especially difficult in an association that is designed to represent many different, sometimes conflicting interests, all of which must be integrated somehow into a cooperative effort to manage risk to the benefit of the users of the CCP as well as the public as a whole. In that respect, governance bleeds very easily into issues of transparency, flexibility of decision-making, and so forth. Some of the issues that are properly construed as governance issues, many of them, in fact, will involve strictly risk decisions. Some of them will not. So we will sometimes see issues of structure, the nature of the decision-making process at a CCP rise to the fore. At other times, we will, I think, see technical issues, sometimes contested, relating to risk management, practice, and policy come to the fore. Underlying all of this, I think, is a fundamental problem of financial regulation, which is the thorny problem of wrestling with fundamental trade-offs. I think that will be well illustrated by the range of topics that have been identified by members of the committee for discussion in this panel. We will find ourselves, I think, from time to time faced with choices that can't easily be reduced to a single solution. Lastly, one of the objectives of this panel discussion is to identify best practices that can be adopted more broadly by the industry. I emphasize the plurality of the term best practices. There may be an inadvertent or subconscious inclination to regard best practice as implying that only a single path is possible. As Commissioner Benham noted in his remarks this morning, flexibility can be an important contributing factor to the coordination and cooperation that is necessary for these markets to operate properly. And we should remind ourselves, I think, that flexibility and diversity itself can contribute to financial stability. That concludes the general framing remarks that I have. And so I hope that they will serve as a foundation for the conversation to follow. Let me turn now to the first of our speakers. Marnie Rosenberg is Managing Director and Global Head of Clearinghouse Risk and Strategy at JP Morgan Chase & Company. Her biographical information is available in the packets that are being circulated. I thought I would not take the time of the committee to go into that detail. Marnie, would you please begin with your opening statement?
Thank you, Robert. Good morning. My name is Marnie Rosenberg, and I'm the Global Head of Clearinghouse Risk and Strategy within JP Morgan's independent risk management function. Thank you, Commissioner Benham and Alicia Lewis, for putting the topic of clearinghouse risk and governance on today's MRAC agenda and for providing me with the opportunity to present our views. We have raised issues related to CCP risk, recovery, and resolution through 2 JP Morgan white papers, and a recent clearing member default has once again highlighted the importance of getting clearinghouse risk management and governance right. Derivative market reforms, including swaps clearing mandate and non-cleared swaps margin rules, have increased the volume of cleared derivative transactions. While this has reduced central counterparty clearing risk and enhanced transparency in the derivative markets, it has also led to concentration of risk in CCPs and increased interconnectedness within the system. Global standard-setting bodies and regulators, including the CFTC, have recognized the need to assess the full implications of these changes and determine whether enhancements are needed to ensure that CCP's risk management and governance frameworks remain commensurate with the systemic role that CCPs have now assumed. While good progress has been made, opportunities remain to further improve CCP governance and margin and stress testing frameworks, as well as increase CCP capital contributions through enhanced regulatory standards and oversight. CCPs make key decisions with respect to how they manage risk, setting membership and eligible collateral criteria, margin levels, and overall financial safeguards, as well as determining specific products that they will offer for clearing. And most of the global CCPs are subsidiaries of publicly owned holding companies that face competitive pressure to maximize shareholder returns. At the same time, clearing members bear the consequences, the capital consequences of losses through the collective default fund contributions they provide to the CCP for loss mutualization. This model creates an imbalance by separating the rewards of ownership from its risks, creating a misalignment of risk management incentives. Risk governance rules should ensure that those that bear potential losses have a meaningful voice within regard to how risk is managed. While employees of some clearing members participate on CCP risk committees, this does not equate to member input into decision-making, as representatives have varied roles. As such, there is a need to enhance CCP risk management governance processes such that they incorporate independent expert views from representatives of end users and clearing members who serve as members of a CCP's risk committee. Provide all clearing members with an opportunity to provide their input at the design stage on key risk decisions being considered by a CCP, and require appropriate documentation of a CCP's rationale and justification in cases where feedback from a clearing member or risk committee is not incorporated. While the governance requirements I just described exist under the EU's European Market Infrastructure Regulation, or EMIR, they do not form part currently of the CFTC's rules. Incorporating enhancements in Part 39 and Part 40 of the CFTC's regulations would serve to enhance CCP resilience by ensuring that participant risk management expertise is duly considered and incorporated where appropriate. Enhancements to CCP governance, risk governance frameworks should be coupled with a requirement for CCPs to contribute meaningful amounts of own funds capital or skin in the game to ensure alignment of incentives. While many CCPs contribute some capital to their default waterfalls, amounts do not scale with risk and represent a small percentage of the member default fund, therefore not being sufficient currently to ensure alignment of incentives. As an example, in the US, one large listed CCP does not have any skin in the game, while another holds capital equal to 3% of its member default fund. neither of which is sufficient. Regulators should ensure that CCP capital is sufficient to both align incentives for management of default losses and cover non-default losses, which should not be borne by members and their clients. We support the CFTC's commitment to fair and open access and believe that implicit with providing access to well-capitalized members is the need, less capitalized members, is the need for CCPs to actively monitor and manage exposures brought in by such members. CCPs must ensure that each member can meet increased margin calls and must be able to take action to reduce risk towards members with weakening credit. Margin frameworks we view as the first line of defense in case of a member default. CCPs must ensure that their margin frameworks are robust, are stable, account for position concentration, and are adequate through the time it takes to close out a defaulter's positions. We have observed significant margin breaches during periods of high volatility this year. CME, ICE, OCC, Japan Securities Clearing Corp, NASDAQ, and Eurex all experienced margin breaches in excess of 100% based on a one-day market move. And these were followed by the CCPs subsequently increasing margin levels. Pro-cyclical calls for margin could trigger defaults by weaker members. More work, we believe, can be done by CCPs to demonstrate that the margin period of risk assumed, as well as the margin collected, adequately reflects the liquidity profile of the underlying product, regardless of how the product is traded or classified, whether it be OTC or listed. Lastly, participants need sufficient transparency over CCP margin and stress testing methodologies to enable them to conduct in-depth analysis and be able to fully understand their membership risks. Transparency still remains a challenge despite steps taken by the industry and regulators to enhance disclosures. Thank you, and I look forward to our discussion.
Thank you, Marnie. I'll turn now to our next panelist, Alicia Crichton. Alicia is Chief Operating Officer, Prime Services, U.S. Clearing at Goldman Sachs, and she is representing the Futures Industry Association in her remarks here today. Thank you.
Thanks, Bob. Good morning. I'm Alicia Crichton, and I'm the COO of the Prime Services Clearing businesses at Goldman Sachs. And as Bob said, I'm also the FIA representative to MRAC. It is as the FIA rep to MRAC that I'll be speaking to you today. Thanks to Commissioner Benham and to Alicia Lewis for the opportunity to speak with you this morning. The increase in volumes cleared by CCPs, particularly stemming from the G20 mandate, can lead to enhanced financial stability, but also requires that CCPs engage in strong risk management. FIA and its clearing members are strong proponents of a healthy and safe clearing system that mitigates systemic risk for the clear derivatives business. While FIA members are focused on a number of areas related to CCP risk management, I'll categorize my remarks today into three categories: governance, adequacy and resources of CCP member firms, and CCP skin in the game. On governance, I'll highlight four areas important to FIA members. First, regulatory supervision of CCPs should include regular and granular assessments. These assessments should include strong testing across a range of scenarios and at different stages of default management to ensure adequacy of resources when they're needed. Stress testing by regulators is an essential aspect of supervising CCPs and thus ensuring financial stability. While regulatory supervision is critical, it is important to note that all parties involved, clearing members, CCPs, and regulators, have a crucial role to play in the risk management ecosystem. Second, CCPs should establish a framework to give clearing members a more robust role on risk committees. Risk committees need to have a greater say with regard to products cleared, the robustness of their margin methodologies, and which default fund is appropriate to cover products. Current involvement of individual members in risk committees is inadequate for ensuring reliable and sufficiently robust margin methodologies, and CCPs should ensure a high level of transparency of their margin methodology with members and establish a framework whereby input from members on the methodologies can and should be considered. Third, CCP default management processes should be transparent, and CCPs should permit clearing member participation. The design of default management processes, including the use of auctions, is critical in minimizing losses. As FIA has argued, transparency is critical to members, and this criticality continues post-default. Issues such as the number of participants in, how the defaulter's portfolio is arranged for, and whether an auction is necessary in light of the nature of the product are critical interest to non-defaulting members, since they are required to absorb losses resulting from the defaulter's portfolio. Fourth, CCP should enhance governance around the development of margin models to bring the quantitative and risk management experience and resources of clearing members to bear. CCPs ensuring the defaulter's initial margin is the primary source of funds to meet the CCP's losses upon default, and so ensuring margin model adequacy and performance is critical. Margin should cover market risk over the period that it would take to detect a default, commence default management proceedings, and liquidate a defaulting participant's positions. Concentration and liquidity risk must be accounted for by CCPs, and this is best dealt with as part of margin. In addition, cross-product netting of margin should be considered from the perspective of risk management and the robustness of the underlying rationale, and not margin efficiencies. Margin efficiencies which yield lower requirements should not be a source of competition among CCPs, and issuing intraday margin calls to members should not be seen as an alternative to adequate margin levels, and should be primarily used to ensure the CCP does not extend more credit to members than appropriate. There is more work to be done in order to remove the uncapped liability to clearing members on some international CCPs, as this risk is unsustainable to the clearing member community. With regard to adequacy and resources of CCP members, first, FIA believes CCP membership criteria should be fully transparent, detailed, and specific. Second, CCPs should not rely on only external credit ratings for monitoring membership. They should have an internally developed credit framework, whether it is outsourced or applied by the CCP's risk function, for reviewing creditworthiness of participants. Third, CCPs who wish to include self-clearing members should develop specific provisions in their rulebook, risk framework, and governance to account for the nature of these members. A self-clearing member does not have the buffer of another sophisticated financial intermediary carrying out risk monitoring, and thus requires a higher level of scrutiny by the CCP. This level of scrutiny could include exposure caps for more thinly capitalized firms. Any market participant that is not capable of having in place meaningful trading and risk controls and credible separated business functions such as risk, compliance, trading, and operations, which are independent of one another, should not be permitted to be a clearing member of a CCP. Lastly, FIA believes CCP skin in the game should align the interests of CCPs with those of its members. Specifically, it should be calculated by reference to the level of risk being managed by the CCP. To act as an incentive, a significant portion of it should be used ahead of any non-defaulting member resources in the default waterfall. It should be correctly sized for the potential default of self-clearing members, taking into account that they may not be required to provide default fund contributions under the same calculation as other clearing members, and may not have the financial resources available in stress scenarios that larger financial institutions do, and it should be dynamic and recalibrated periodically to account for the changing level of the default fund. Thank you again for this opportunity. I look forward to taking any questions that you have.
Thank you, Alicia. Next, we have Lee Betzel. Lee is Managing Director and Chief Risk Officer at CME Group. Lee.
Thank you, Robert. I'll just clarify, I'm the Chief Risk Officer of the CME Clearinghouse. I'm Lee Betzel, and like my other panelists and other members of the committee, I thank Alicia and Commissioner Benham for organizing this event and for the opportunity to be able to speak about CCP risk management. In my prepared remarks, I'd like to briefly discuss clearinghouse governance before we begin the more fulsome panel discussions. As background, CME Clearing CME's clearinghouse maintains a dedicated clearinghouse risk committee, which is comprised of market stakeholders, including clearing members, clients, and independent members. In addition to this committee, CME maintains a clearinghouse oversight committee, which is comprised of board members of CME Group. The CME Clearinghouse and its senior management team, along with the Clearinghouse Risk Committee and the Oversight Committee of the Board, have dual mandates to focus on the safety and the efficiency of the clearinghouse and to support the broader stability of the financial system. The incorporation of these mandates at each level of the clearinghouse risk management and the governance committees populated by market stakeholders and the board members is designed to ensure that safety and financial stability are at the forefront of our daily and strategic risk management decisions. These mandates also ensure that every level of the CME Clearinghouse governance program, ranging from internal governance by CME Clearinghouse senior management of risk management staff to the external and board level governance provided by the Clearinghouse Risk Committee and Oversight Committee respectively, and to ensure that it performs its oversight functions with the broader risk management implications of those decisions taking precedence. Additionally, such decisions are transparent to market stakeholders through consultation, through rule changes, through advisories, and such avenues as the public quantitative disclosures. The governance structure of the CME Clearinghouse also focuses on ensuring that a range of market stakeholder views are incorporated into risk management decisions by maintaining a diverse representation on the Clearinghouse Risk Committee. This structure seeks to avoid the potential risks that could result from limiting risk management feedback and input to just a subset of market stakeholders. We believe it is critical to have a diverse and robust input to achieve the best risk management results for the entire market and to ensure that the inherent financial stability benefits of the central clearing market structure, driven in part by a careful balance between defaulter and mutualized resources, as evidenced in past market stress events, are maintained. That concludes my prepared remarks. I would, if it's allowed, like to just make a few comments on the opening statements by my fellow panelists. I do appreciate the thoughts that have been expressed. I also appreciate the work that the FIA has done to produce its thoughts on the CCP risk management. I have to say that as a risk manager of a CCP, I am in agreement with most of the statements and thoughts as they've been outlined. I do feel like at its whole, though, there is an implication being drawn that incentives between CCPs and its clearing members are misaligned. I don't believe that to be true. CCPs, irregardless of their ownership structure, are completely and 100% dependent upon its clearing business for all its future its revenues. The mutualization of risks are the foundation of the CCP arrangements today, and the CCP risk managers working together with the risk managers of its clearing membership are focused on are focused on credit counterparty risk management and should proactively be working together to ensure that risks are managed appropriately. There are no incentives to shortcut risk management for a CCP risk manager because its revenues are dependent upon sound risk management. That incentive doesn't exist. We've seen the dire consequences for getting risk management wrong and continue to focus on improving risk management as part of our daily practice. The FIA is right, and as my panelists have said, are right to highlight margin practices as an important focus. We do look to improve our practices in margining as we conduct our risk management. I would say that margin, though, is only one tool in our arsenal for ensuring that we have appropriate risk management in place. As I said, it's important that CCP risk management works with the risk management of its clearing members to proactively monitor the exposures that are being brought into the CCP ecosystem. To understand the types of exposures that are being brought, to monitor, not just monitor margins, but to monitor the portfolios of both its clearing members and the clients of its clearing members, using things like stress testing of those portfolios to ensure that it can have a view of potential exposures that may result due to changing market situations. In addition to margin, we have other controls that we can use. By understanding those exposures, we can add additional margin. We can add concentration margin, for example, when portfolios get too large, either in absolute terms for the markets that they belong to, or too large for the clearing member itself who's brought those exposures. We can place limits and other controls to ensure that those exposures do not get out of hand. I also think it's right for the focus on default management. Right. After all, the main service that the CCP can provide is that counterparty credit risk management, and the ability to be able to liquidate and to be able to liquidate within the financial resources and specifically margins is one of our goals. The CCP, however, is not a market participant itself. It has expertise within its risk management team, but is not a market participant. And as such, we are reliant on our clearing member community to be able to support the default management practices and specifically liquidations. The main incentive for clearing members to participate in default management is the guarantee fund contributions, which are provided by those clearing members. And we must be careful in reaching a balance of the capital provided in the waterfall by CCPs with those contributions of clearing members to ensure that we're not creating moral hazard and that we are incentivizing clearing members to participate well in that liquidation process. So anyway, those were just a few thoughts on the remarks as they've been said today. I look forward to discussing these and other topics on the panel. Thank you again.
Thank you, Lee. Apologies for the missed introduction. I'm reminded that at a recent event at the Federal Reserve Bank of Chicago, one of my colleagues introduced a representative from the private sector, a very young man, as the founder and CEO of the Federal Reserve System, which would have been a very remarkable thing and would have come as quite a surprise to Jay Powell. So operational risk haunts all of us in all of our endeavors. Apologies again. I turn now to Dale Michaels. Dale, I've got myself flustered here. I have to go back to my list here. Dale is Executive Vice President, Financial Risk Management at the Options Clearing Corporation.
Okay. Hello. Thank you, the commissioners and Alicia Lewis, for hosting this MRAC panel on clearinghouse risk management and governance. I am Dale Michaels, Executive Vice President of Financial Risk Management at the Options Clearing Corporation. I have been in risk management for over 20 years at different CCPs, and therefore welcome the focus of this panel on a topic that is certainly close to my heart. CCPs have performed extraordinarily well during many stressful periods, including the crisis of 2008, and that was due to many clearinghouse innovations that have been put in place, including mark-to-market settlements initial margin models, and default management, to name a few. As a reminder, CCPs do not take on any market risk. We manage the risk. We add a critical risk management function to the financial system and take action when our clearing members are in default, as we did in the wake of Lehman and MF Global and others. As CCPs have become more critical to the financial industry, as reflected in our designation as systemically important financial market utilities, we have endeavored to make our processes even more transparent to the public, with adherence to the principles for financial market infrastructures and the distribution of both qualitative and quantitative information so that users can better understand the overall risk management of CCPs and participate in risk committees and other advisory forums. I'll go through a few of the critical components of the CCP's risk management framework, with the first line of defense being the clearing membership itself. At CCPs, we look to have a broad clearing membership that includes all qualified participants, not just the biggest firms, as we want to have a large diversified membership. As an initial matter, OCC considers whether potential clearing members are regulated entities. In the U.S., this means a broker-dealer or a futures commission merchant, and that they are a corporate entity. Most importantly, each CCP continually monitors the credit risk of each of its clearing members that bring exposures to the clearinghouse by reviewing financial information, the exposures themselves, and market metrics. At OCC, we take this a step further as we perform a risk review of each of our members, both in initial membership and periodically thereafter, to ensure that they meet acceptable risk management standards and have appropriate staffing, risk systems, and expertise. The next line of defense is the initial margin. CCP's initial margin models are distinct from one another to reflect differences in the products and their inherent risk. This prevents model risk involved in using one single approach. Most of the work of CCPs is appropriately to calibrate and review initial margins as conditions and products evolve. This is one of the most critical aspects of what CCPs do. For example, at OCC, we have developed a 10,000 scenario, Monte Carlo initial margin calculation methodology called STANS, which has put us on the leading edge of risk management. However, CCPs can not only look at one aspect of a margin model to determine if it's appropriate. For example, to state the initial margin model meets a confidence level of 99.5% is meaningless without any context. One must look at the entirety of each specific model. As an example, at OCC, the STANS margin approach is based on expected shortfall methodology at a 99% level, which means that we look at all market observations, including the worst case scenarios, and average those amounts from 99% to 100% on the distribution curve to reflect the tail risk. Most other initial margin models will only look at the precise confidence level of 99% to calibrate the margin. In both cases, the CCP would state that it meets 99% confidence level. However, the OCC expected shortfall model, by definition, will always be more conservative as it's incorporating all the extreme market risk. The margin period of risk, the estimated time needed to close out a defaulter's counterparty's accounts, is another critical determination in calibrating the appropriate margins. There is a distinction today between exchange-traded derivatives and over-the-counter products in the regulations of a minimum 1-day margin period of risk for exchange-traded and 5-day margin period of risk for the OTC products, which reflects the liquidity and complexity of those products. We also believe that margin period of risk should be tied to the default management process, which is also shown that a longer time frame is needed to close out OTC products. While the regulatory minimum margin period of risk for exchange-traded derivatives in the U.S. is 1 day, the OCC believes that given the default management experience, which would likely involve an auction process, that 2 days is more reflective of the time frame needed to close out a defaulting counterparty's accounts. The OCC has therefore set the margin period of risk at the more conservative 2 days for all of its exchange-cleared products. In our view, it's not about the regulatory minimum, it's about what is right for risk management. Another important initial margin aspect is the calculation of margin offsets for correlated products. Many CCPs offer margin offsets for products that are both economically and intuitively linked. These correlations must also be persistent and strong, and margin offsets should not be allowed for products that are tangentially correlated or in different asset classes. OCC again has taken risk management a step further in its margin model and runs decorrelation scenarios within its margin model where there's an additional charge at a higher confidence level interval based on the greater of historical, zero, or perfect correlations of products to cover the risk of markets that may be moving in a much different way than they have in the past. Other considerations when reviewing margin models include daily calibrations, length of look-back periods, liquidity and concentration add-ons, wrong way risk, intraday margining capabilities, just to name a few. So considering the universe of margin models, it is not relevant to look at just one aspect of the margin model, but to look at the margin models in their entireties. The next level of defense is the clearing funds themselves. Much of what CCPs have in place for initial margin also applies to stress testing of clearing funds as CCPs look to size those funds at the appropriate level. These include having a robust number of scenarios, decorrelation scenarios, and long look-back periods. The regulatory minimum in the U.S. is a Cover 1 standard, meaning that the CCPs can cover the exposure of its largest clearing member firm. OCC also exceeds this regulatory standard and having implemented a Cover 2 standard, which covers the largest 2 clearing firm exposures. Generally, CCPs look to bring many similar products in the clearing fund and default waterfall to allow them to be risk managed together. While a clearing member may not clear each and every product in that waterfall, we want to have broad participation in a CCP clearing fund rather than have small siloed funds for single products. If there is a small siloed fund, there is no recourse to other financial resources for those funds. A CCP default is much more likely, which would obviously be much more damaging to the customers, the clearing firms, and the entire system. And the last link of the risk framework is default management. CCPs have worked closely with clearing member firms and with other CCPs to have robust default management processing, especially with regards to the auction process that allows the CCP to return to a matched book. This includes vigorous default management testing on the auction process that includes wide participation for both clearing member firms and clients. For some auctions, it's necessary to have mandatory participation so that CCP can have many viable bids, which would allow for the best outcome for the market. Although most importantly in the default management process and in any stressed market environment is for the CCPs to retain the flexibility to be able to react to the facts and circumstances at the time, as the next stressed event will likely be much different than the last stressed events. As a systemically important financial market utility, OCC remains committed to serving as a foundation for secure markets and to ensuring confidence in the financial markets and broader economy. We will continue to invest in solutions that enhance our resiliency and fortify our operational effectiveness to reduce systemic risks across the global financial markets. Thank you very much for your time and consideration, and look forward to the further questions.
Thank you, Dale. Our final panelist speaking this morning is Tyson Slocum. He is Director of the Energy Program at Public Citizen. Tyson, your remarks, please.
Great. Thank you so much. Good morning, everyone. I just want to thank Commissioner Beanham for his leadership on the Market Risk Advisory Committee, for Alicia Lewis for all of the tremendous amount of work that you and others have done to put this together. And I appreciate the opportunity to serve with my fellow panelists and with my fellow Market Risk Advisory Committee members. So Public Citizen is a consumer advocacy group. So we try and represent the interests of household consumers in a variety of different areas. We've got over 400,000 such household members that help finance the operations of Public Citizen. And we try and represent the public interest. The financial crisis of 2008 resulted in domestic and international efforts to enhance risk management, improve transparency, and heighten market integrity with requirements for more transactions to move through central counterparties. These clearing requirements have assigned significant public interest functions to the companies performing central counterparty duties So it is therefore prudent for the CFTC to ensure that both the ownership structures, the legal and regulatory obligations, the transparency of operations of these central counterparties are aligned for maximum protections for members, commodity end users, and the public interest. The CFTC's oversight of central counterparty governance and transparency is guided by core principles. And these core principles are very broad, and the CFTC actually attempted to dive in and provide a lot more detailed requirements in proposed rulemakings in 2010 and 2011 that ended up not going anywhere. And so as a result, efforts to codify and strengthen those rules remain incomplete. And I think one of the outcomes of the discussions we're having here today would be for the Commission to revive rulemaking efforts, particularly on governance, transparency, and conflict of interest of central counterparties. Such efforts could include explicit standards for compositions of boards of directors, disciplinary panels, risk management committees, addressing the role of members on risk management committees. We heard from JP Morgan about certain specific requirements under EU rules that do not exist under CFTC rules. And so I do think a proposed rulemaking to address certain aspects of the operations of these risk management committees would be helpful. Ensuring that incentives between central counterparty business models, including all their affiliate interactions, and their members and end users and the public interest are all properly aligned. I think ensuring a measure of independence of the risk management committee from the board of directors would be helpful, and stronger reporting requirements to address potential conflicts of interest. So thank you very much for your time, and I look forward to any questions.
Thank you very much. At this time, I'd like to offer the panel an opportunity to comment on what has been said so far. I think it would be very helpful to the further discussion by the committee to hear your thoughts about what was said by your fellow panelists.
Robert, thank you. I'll just make a couple of remarks, comments. So the first thing I would say is JP Morgan has 100 memberships, over 60 clearinghouse groups. So I think it's important that the comments that I presented really represent our views across our CCP portfolio and the exposures that we have. Now, the largest exposures, of course, are towards the largest CCP groups, and we spend a lot of time focused on the risk management, the transparency, and the governance around those groups. So I just want to make that as a general statement. In respect to some of the comments, the remarks that were provided, I would just reiterate a couple of things. One is that clearinghouses do take risk. So I think that's a really important point to emphasize. They make decisions every day that affect individual clearing members, clients, and the market overall. So they are making decisions about risk management that could create, risk down the road, and I think that's important. The other thing I want to say is about governance. So with respect to governance, and particularly around clearinghouses engaging with members and their clients around decisions or material changes that could affect ultimately the capital that clearing members contribute to the default fund, there's no one-size-fits-all approach. So every clearinghouse has a different approach. Some, from a communication standpoint, are very start engaging very early on in the design process through risk working groups. And this is a very effective way to genuinely get member input, not a check off the box, but genuinely engage with the membership community, get input, and that input then gets discussed at the formal risk committee that ultimately helps shape any proposed rulemaking. Whereas other CCPs tend to, when we sometimes find out about changes, they're actually through public, well, I would say rule filings where members can provide public comments. And we think that way is not as constructive. So those are the couple of comments I would make. In addition to transparency, I would say the CPMI OSCO quantitative disclosures are very helpful to the market, but we don't think that they go far enough. And we do believe, again, across the portfolio that we have of CCP memberships, some clearinghouses are better than others in sharing information that we can therefore evaluate our risk. And it really varies across the spectrum. And I would encourage the CFTC and other regulators to continue to have these discussions about encouraging clearinghouses to share information, even on a bilateral basis with their members that hold a lot of the risk, even if it's through NDAs, confidentiality agreements. I sit intentionally within the independent risk management structure at JP Morgan. We are the private side of the organization, and we contain any information we receive within our function. Thank you.
I'll just add a few more comments to Marnie's. The first thing, and I think, Lee, you highlighted this, and it was in my comments as well. I think the notion of FCMs being risk managers alongside CCPs is an important one, and I think our interests are very much aligned. And I think two things that sort of brings up as areas of focus, and we've touched on those, but I think it's worth highlighting them again, is one, the governance around membership criteria. I think because we are risk managers alongside of each other, in the instances where self-clearing participants are going direct to the CCP, they don't have the buffer of another FCM performing that risk management role. So as an industry, we are reliant on the CCP to perform those risk management obligations. I think the second piece in there is the setting of margin and the transparency and the detail of information provided around setting of margin. I'm not sure as an industry we've necessarily solved for the right level of transparency and the communication with, I think, the broader community. I think closely tied to that, and Dale, you touched on the setting of margin period of risk. I think it's incumbent on all of us, I think, to strengthen the relationship between stated MPOR and initial margin. So, and I think more work needs to be done there. And the last piece that I'll just touch on is the default management proceedings. I think, again, more work to be done in regards to member input, particularly to enhance the liquidation proceedings. And I think balancing the amount of information that's given to whether it's the auction participants or the default management committee, the composition of that committee, I think are all areas that we should be discussing further. Thank you.
Thank you, Marty and Alicia. I must say, just from my own perspective, those comments help shape more generally your approach to some of the issues that have come up. From my perspective, when I saw some of the issues that were listed by MRAC committee members as topics for concern, at a first blush, you might well ask yourself whether the system works at all. There are so many issues to be addressed, and yet it does. In fact, it works well enough that the leaders of the G20 decided to make it an important component, it being central clearing, of the financial stability program for the world. Marnie, your remarks in particular point out that there is some diversity of practice globally and in different parts of the industry addressing particular asset classes, particular markets, and that's important for us to remember as well. Dale and Lee, would you like to make further comments based on what you've heard?
Sure. So this is one of those items that I think that we are in agreement with the comments here as far as including the clearing membership and others as far as the overall governance process at OCC. I mean, it would be silly not to. These folks have experts in the industry that could help us out. We wouldn't ever think that we have the monopoly of experts on clearinghouse risk management. So at our organization, at OCC, we do have a financial risk advisory council. This is made up of clearing member firms and clients. We bring all model changes, clearing fund changes, default management processes through that body. And that body has a direct link to our risk committee so that everything that's discussed, any issues that are brought up, are then summarized to the risk committee themselves. And they could act on, or if they decide not to act on, we bring it back to that council to give them the decision as far as to why it wasn't. So I think there is that process in place at some CCPs. I'd say the one thing that I also want to comment on is the default management process. We certainly need to engage with the clearing member firms, and we practice this at least once a year, if not multiple times a year at CCPs. It is that important to get the operational pieces of this down so that folks can know when they're bidding on a portfolio how to bid, what is the information that they're looking at. I would say there is a little bit of tension here between what I'm hearing sometimes in these types of forums as far as wanting to participate in default management versus what you have when you talk to the actual desk who are providing bids. When we are going through the default management process, a lot of the times we are not getting their attention. And we don't get that type of cooperation. In some cases, we have to, when we don't get that cooperation, we have to take action and bring it to our risk committee and find these members because they have not participated, even though they realize it is critical that we have this process in place. So, there is that balance that has to be struck as well.
Yeah, thanks. Let me just address a couple of the points that have been raised. You're right, Robert. There's been a lot thrown out there, and despite it all, we do actually function on a day-to-day basis in the clearing space. If I could address the comment on the self-clearing membership that Alicia raised. On this topic, and as Commissioner Berkovitz pointed out in his opening statement, diversity of membership is important in the clearing infrastructure and ecosystem. The market itself benefits from having a wide range of participants in its markets, from institutional hedgers, commercial hedgers, to speculators and retail clients. We benefit from that large ecostructure, and that does take a diversification of the membership. Now, the majority of CCP business on the clearing side is conducted through FCMs or client clearing business. But the proprietary trading of firms also is a very big and important part of the clearing infrastructure. And I would point out that some of our largest self-clearing members are, in fact, the large banks who also own FCMs. Due to capital pressures, we've seen a number of banks become self-clearing members. And I don't think there's anything inherent riskier about those self-clearing members. As Dale pointed out in the membership criteria, we need to ensure that all of our members can support the clearing business that they bring into the CCP. They need to have the operational capacity. They need to have the independent risk oversight. And we need to work with those clearing members, just like our client clearing firms, on ensuring that the exposures that they bring into the CCP are commensurate with their own financial resources and the levels that they can support. And it's not just capital levels, right? One of the things that we look at is the form that capital takes. Liquidity risk is a very important part of the clearing ecosystem. In that we are running daily mark-to-market. In our case, for futures and options, twice a day, running a variation margin settlement, which requires flows of money. So we need to ensure that the firms have the right form of capital to be able to meet increases in margin calls and the changing market infrastructure. So everybody can get risk management wrong from time to time. It's how we're able to react to that and to the changing situation. And I don't think that self-clearing members are inherently riskier than other clearing members, and indeed that we benefit from having smaller clearing members in the ecosystem. Could I also just make a couple of points on governance? I started out in my opening statement on governance, but Tyson has raised it, and it's been a theme here. I think at least at CME, the composition of our risk committees, the composition of our board is set out to ensure that there is both a wide ranging input in experiences, and that there is the appropriate challenge and oversight by the board. So our risk committees are rather large. I think our clearinghouse risk committee for futures and options is 16 members strong. And the majority of those are from clearing members. So we do get very much the clearing member view. People have raised the question of NDAs for committee members. Those are important when we are bringing early discussions on potentially competitively sensitive material. But the majority of what we bring is not commercially sensitive. I'll take the example of enhancements that CME is making to its SPAN margin model. We have been consulting on a bilateral basis with our market stakeholders for more than a year and a half now. We've done hundreds of bilateral meetings. We've discussed in forums. We have operational and risk working groups looking at the new model. And all of that is input into the risk committee decision to move forward with what will be a material change. It also has to go through our board committee, the approval. We need to bring the views of the market as a whole, the views of the risk committee, and get approval from the board to move forward with a material change. And lastly, of course, we need to get a regulatory approval for those types of material changes. So for us, this enhancement to our margin model is a multi-year process of ensuring that we get it right. I'll stop there. Thanks.
Thank you, Lee. I think it's appropriate for us now to invite participation by MRAC members, and to start off, Alicia, will you introduce?
Well, I know the 10 cards are about to fly, so we're going to go to the phone first, so that we'll be able to get the views of the members on the phone. Is there anyone on the phone that would like to make a comment or has a question?
Hi, good morning, Alicia. This is Rana Yard from Goldman. I would like the opportunity, if you please.
Yes. The chair recognizes Rana Yard of Goldman Sachs.
Thank you. So, echoing some of the comments that have made by the distinguished panel, we want to emphasize a few points on behalf of Goldman Sachs. First, as an institution, we view well-functioning risk committees to be those that allow a high degree of direct clearing member participation and which make decisions that are based not on what is most commercially expedient for a CCP, but rather what would be viewed as prudent risk management of the clearing members and indeed the clearing house's own capital. It is for that reason that we believe that clearinghouses having appropriate amounts of skin in the game aligns interest. In the same way that we don't wish to lose our capital as a non-defaulting member, we assume that the clearinghouse will be more incentivized to make the strongest and most robust risk management decisions if the consequences for not doing so are having their own capital at risk. Secondly, we want to make sure that in discussions about CCP best practices that we avoid alluding to risk management standards being different between listed and OTC products. We view riskiness as not a function of the product form, but rather as a result of liquidity, volatility, market concentration, and expected availability of hedges and the timing of those hedges for an effective default management process. If a clearinghouse applies for a short MPOR to the products that it clears, the onus should indeed be on the clearinghouse to demonstrate that the margin is appropriate and sufficient. This case should also be supported with a suitable amount of additional clearinghouse skin in the game capital, and further, this support should be furnished to the relevant risk committees previously mentioned by the speakers on the panel to get appropriate input from not only direct clearing members, but also independent members of the risk committee. We believe further that idiosyncratic risks should be housed in segregated default funds and refer to our previous views around the appropriate segregation that we see of OTC swap products and our views around this need for segregation of crypto assets. Finally, while we wish for some degree of certainty in respect of the rule books, we want to acknowledge that being overly prescriptive limits the range of options that clearinghouses and default management groups have in a default scenario in a manner that could potentially cause further losses. To that end, we believe it is important that default management groups, which are the groups that are endowed with the ability to actually hedge the book in a default scenario. Sometimes they're employees of the clearinghouse. Sometimes it is a group that is drawn from the membership, has the flexibility that it needs to react to market conditions and the peculiarities of each default. You know, one of the previous speakers said that the next default won't look like the one that happened directly before it, and we think it's very important to not write the rule books that solves for the default that we just saw, but rather that provides the clearinghouses and the DMPs and the risk committees which oversee them with a toolkit that has the appropriate tools to handle the next default. With that, thank you for the opportunity to speak to the group.
Thank you, Rana. Is there anyone else on the phone that has a comment or question?
Hi, it's John Murphy with the Commodity Markets Council.
The chair recognizes John Murphy from Commodity Markets Council.
Thank you, Alicia. I appreciate it. Thank you to the panel for your comments. I just have a quick question that anyone on the panel can answer, and it pertains to the default management process. And again, without being too prescriptive around the auction process, I think that what we do need is more transparency around the auction process. I think we saw recently in Europe with the default on the exchange in Europe that there were issues with the number of participants involved in the auction process, which probably caused some additional market stress that was unintentional. But what do you think a process would be from an auction perspective that would be more reasonable and more resilient on a go-forward basis without causing more market stress if you are in the midst of a market environment? So does anyone have any opinions on what the appropriate auction process really should look like?
The chair recognizes Lee Betzel, CME Clearing.
Thank you, Alicia, and thanks, John, for the question, and Rana as well. I think both of you touched on similar topics as it comes to default management. Liquidation is difficult, right? To get right. There is a balance always in having enough participants to be able to support a good auction in the sense that you get the best prices, and telegraphing the position that you're about to unload on the market. You can go too wide. So it is a difficult thing to get right. I think Rana pointed out that there should be a difference in the default management approach between OTC contracts and listed contracts, and I think that's right. In the listed markets, we do have the benefit of an order book of more liquid products, which can be utilized in the default management process, making hedging or liquidation more efficient from the CCP standpoint. Whereas I think most CCPs who offer OTC markets utilize their risk committees or default management committees to be able to advise the CCP on the best method for liquidation, and that usually involves analyzing the portfolio and suggesting hedges, which can be put on before the OTC positions are liquidated, and the primary tool for that is via auction, given that we don't have an order book that we can go to in the CCP. So I'm agreeing with that. I think to the transparency point that you raised, John, we try to get this right, as Dale pointed out, by having regular default management drills, liquidation drills. We practice this regularly with our membership to get the operational elements right, and also to ensure that everyone knows what sort of action the CCP will be taking in the auctions. The results of those default management drills are subject to extensive write-ups. In our case, we share those and discuss those with our risk committees, and get feedback on how we're doing with those drills. But it's basically to get the community comfortable with what will happen should we have a default, and we do try to be transparent about that. On transparency general, I'll just say to close that, of course, we do regular due diligence visits with our clearing members, all of them, and that's both the CCP looking at the risk practices of our clearing members to ensure that they continue to meet membership requirements, but it also comes the other way. So clearing members perform due diligence visits on the CCP, and we try to be as transparent as we can with our practices in those types of visits, including over our default management practices. I'll stop there.
Thank you, Lee. The chair recognizes Kristen Walters, BlackRock.
Thanks very much. Thanks, Commissioner Benham, for raising the important issue of CCP resiliency, and to the panel. I share many of the views that were discussed. I think the recent NASDAQ default highlights BlackRock's kind of long-standing and public views that steps need to be taken to improve CCP resilience, both to reduce systemic risk as well as to prevent loss allocation to end investors, whom BlackRock represents on a fiduciary basis. Just wanted to highlight a few issues. One, skin in the game, which a number of folks have spoken about this morning. Incentive alignment continues to be a very real problem. Both regulatory requirements and market practice have resulted in skin in the game that does not appropriately align incentives for CCPs who benefit from the clearing mandate. And we believe that the recent loss allocation may have been avoided in its entirety if the CCP had more skin in the game. It's important to point out that we're not just advocating for more skin in the game, but we'd like to see the relevant regulatory bodies just develop a robust and defensible framework for assessing and applying appropriate levels of skin in the game going forward. Around exchange traded versus OTC markets, the OTC derivatives markets have benefited by margin adequacy methodologies that are more risk sensitive, as well as enhanced default management procedures. Those changes have not been made on the exchange traded side, and certainly we've seen that liquidity can be an issue in both markets, and we are advocates for similar changes to be made to kind of legacy margin methodologies on the exchange traded side, as well as default management practices. Definitely believe that disclosure standards need to be improved. Many of the risk management shortcomings that were revealed by the recent CCP loss allocation were not readily apparent from their disclosures, and in fact, CCP's disclosure requirements continue to be less than some of the smallest public companies in financial markets. Finally, just with regard to protecting end users and taxpayers, just to note that VMGH continues to be captured in CCP rulebooks, and we would like the regulators to address this issue. We do not think that it is we do not advocate for VMGH being used by CCPs, and if used at all with some caveats, it should be only in the instance of resolution. I would just note that everything that I said, we've been saying, I've been saying on behalf of BlackRock for the last several years on MRAC. They're not new ideas, they're just basic best practices around risk management and governance that we think need to evolve in this space. I would ask folks to reflect on the buy-side perspective on CCP risk that we presented. Angela Patel from Putnam, Bill Thum from Vanguard, and I presented a few years back on the back of the recommendations we made to SIFMA AMG. We feel those recommendations are still we still support them. And finally, a couple of viewpoints that BlackRock has written on the topic of CCP resiliency. One back in 2016, and then very recently we put our thoughts together on an end user's perspective on central clearing at 10 years post-financial crisis. It addresses many of my comments today, as well as the views of folks on the panel. So thank you very much.
The chair recognizes Biz Chatterjee, Citigroup.
Alicia, thank you for the opportunity to ask a question. Just a question, not a statement. It seemed like the discussion initially was focusing on most of you that there could be best practices that various CCPs follow that could be shared across the CCP ecosystem and that people could pick on. But based on statements and comments, it almost seems like, well, no, there are areas where it doesn't apply. For leagues, you mentioned that the default management and the liquidation of a portfolio for OTC and listed could be very different. So I'm curious to hear from the panelists, like what areas do you think best practices can be transported from listed to OTC markets or vice versa? Is it in the softer areas of governance, transparency, or is it for margin and auction method? And Dale, you mentioned that you want sticking to the prescribed minimum regulatory, and you're focused more on a risk approach for MPOR. Lee, you mentioned reliance on listed markets for liquidation, but we all know in stress markets, even listed markets can be thin, and block markets may exist away from the listed market. So I'm curious to hear, like, where do you think these best practices can be extended and where they fall apart?
I think when you...
The chair recognizes Dale Michaels from OCC.
Sorry, I got a little aggressive there. I think when you look back at when the rules were put in place, there was a definitely dichotomy between OTC and exchange traded. They were very different. We just started to clear the OTC products. There wasn't a lot of visibility into them. I think as these markets have developed and we've looked at the standards, I think there is starting to see some coalescing around one broader risk management theme. I'll just take an example of default management, one of my favorites. When you look at what we put together for the OTC types of products, it was mandatory default management groups, mandatory participation in the drills, and if there are actual defaults that occur, the juniorization and seniorization of clearing fund for those that participate well or not so well. I think when you look at what has been put in place for exchange traded, there wasn't that mandatory types of actions. You look at what's been occurring more recently, many CCPs have put into place mandatory testing. Some CCPs are looking at mandatory participation in exchange traded if you are clearing the product. So you can kind of see it starting to morph into that direction as far as let's take the best practices that are out there and get it into the one best practice rather than keeping this perhaps sometimes artificial dichotomy and figure out what is the best approach. So I think I'm starting to see it certainly in default management. I think you're starting to see it elsewhere as well as far as risk management and margin models. I think the margin models on the exchange traded side were developed at a point in time. I think they are advancing to probably more of the sophisticated margin models that we're seeing today, whether they be VAR or expected shortfall or things along that line.
Actually, I have to recognize Marnie first. Marnie Rosenberg.
Thank you. I'm just
JP Morgan.
responding to Biz's question from our perspective, where we think there could be best practices. One which I can't emphasize enough is greater transparency, sharing full documentation on margin and stress testing, as we said, is because members bear most of the risk through the default fund. A few other areas in margin, which I think which have been developed primarily in the OTC space, which could really should be thought through more on the listed side, is appropriate concentration add-ons. So in the swap space, we as well as other members participate in liquidity surveys. We provide feedback into to the CCP. Oops. Hope that wasn't me. I would say on the listed side, what we see across our portfolio is not as much of a robust concentration and liquidity add-on framework, which really should be based on average daily volumes and should be transparent to the market. The other area we see which is growing in adoption, which we support, is utilizing a stress margin framework. So when clearinghouses calculate stress losses above margin, consideration more broadly should be for requiring those members that bring stress loss to the market to pay more in margin. And then the other thing I would say, which Alicia did mention, is on capping liability to members. The only way we can effectively manage our risk to the system is having an effective cap on our liability.
Lee Betzel, CME.
Thanks, Alicia. Can I just go back to the best practices remarks that or the question that B's asked? We do in the CCP community attempt to share best practices. Dale and I are both members of CCP 12. There's each in Europe. There's the post-trade working group at WFE. We do get together and attempt to share best practices. A good example was just last week in Singapore in association with the FIA meeting last week. There was an event organized by CCP 12 to share and do some training on default management and auction practices. And as a group, we offered that to CCP 12 members to come and learn more about how others do it. So we do make an attempt, despite being in a competitive environment. We do make an attempt to share best practices with the thought in mind that if we raise the standards across the board, that's good for us all. And by the way, on the Nasdaq default, the Nasdaq has, as I think most of you know, undertaken an independent study to look into what happened there, and Nasdaq have let us know that within the CCP community they will share the results of that independent study and use that as a best practices platform for further discussion.
Thank you, Lee. The chair recognizes Laura Klemple from DTCC.
Thanks, Alicia. I just wanted to pick up on one of the points Marnie raised regarding the fact that, at least in certain cases, JPM's view is that the quantitative disclosures of certain CCPs don't necessarily go far enough in terms of what the CCP is able to disclose about the exposures that market participants have vis-a-vis the CCP. And I think it's just important to raise that in terms of the CCP's obligation to be as transparent as possible with its members in terms of helping them manage the exposure they have to the CCP, there's always a tension in terms of what we can actually disclose without violating our obligation to keep commercially sensitive information and transaction level information of our market participants confidential. So I think that definitely there's probably more that can be done to strike a middle ground to provide more information, at least in certain cases, in terms of what the CCP is able to disclose. But I don't think that a non-disclosure agreement or any other sort of bilateral agreement between a CCP and a market participant would work for that purpose. I think if there's going to be additional transparency and potentially sharing of confidential information with market participants, even in a control function, I think the norms around how that information would be shared and how it would be controlled would have to be multilaterally agreed by the CCP and its membership.
Thank you, Laura. The chair recognizes Salman Benai, IHS Markit.
Thank you, Alicia. Thank you, Commissioner Benham, for facilitating this important conversation. Just had a couple comments. First, under the header of diversity and competition in these markets. So that's a theme that's very much consistent with the value that we provide the markets as a leading authorized trade processor at all the major clearinghouses. We provide economies of scale as it relates to post-trade processing, which encourages competition and stability at the trading and at the clearance level. In addition to the value of diversity among market infrastructures, there's also diversity in the methods used in stress testing in particular. And one of the things I've noticed out there, OFR back last year, about a year ago, published an interesting paper where they looked at the network of exposures across the CDS markets. And they looked at OTC as well as cleared CDS exposures, and they found that the leading clearinghouse was maybe not as robust to systemic shocks as a similar CFTC stress test that was published a year earlier suggested. So that might be an area where the Commission, given its data that it can see across both clear positions and OTC positions, can provide some additional value and some validation or critique of that OFR paper. And then secondarily, the topic of skin in the game has come up repeatedly at this MRAC meeting as well as past ones. One suggestion I had in looking at papers on systemic stability that have come out of the financial crisis is perhaps there should be a layer of debt capital that comes before we get to the guarantee fund that would be issued by the CCP, and it would be unsubordinated debt. It would be reissued periodically, often enough so that you could do a proper mark-to-market of it. It would both reduce the cost for the CCP to provide that additional layer of debt capital, because the CCP would only be providing interest payments. And then it would also provide regulators in the marketplace a market-based measure of what the CCP's riskiness might be.
The chair recognizes Chairman Giancarlo.
Thank you, Alicia. Salman, I just wanted to respond to the reference you made to that OFR study, because I wouldn't want members to come away thinking that we didn't look at that very carefully, because we did. I don't have our chief economist here, but our Office of Chief Economist looked at it, and perhaps at another meeting we might have them speak to it. But we had major issues with their conclusions. Some of their fundamental understanding of how our markets work was incorrect, and so perhaps at another meeting we might have that. But I wouldn't want anybody to think we didn't look at it carefully, because it on its face it would contradict our own studies. But in fact, we found it to be deficient quite substantially in basic understanding of how clearing in our markets work. But perhaps at another meeting, if it's appropriate, we can speak to that so that the committee can understand where differences lie.
If I could just react to that very quickly. And I appreciate that, and not to imply that that analysis wasn't undertaken, but I think as a member of the public, some transparency around that dialogue, that back and forth would be a helpful thing.
I think we should do it.
Okay, we have 10 minutes. So I'd like to get Susie, then Lindsay, and then Dimitri, and then, Kristen, were you okay. I want to get the people who haven't spoken yet, and then go to the phone really quickly, and then I'll come back to those who have spoken. So the chair recognizes Susie White.
Thank you, Alicia, and thank you, Commissioners, Chairman, for prioritising this important topic. I'd like to bring the panel back to stress testing, if I may, and I think all the opening points were very helpful. A number of you mentioned stress testing. We believe stress testing is at the core of any effective risk management framework, and I appreciate the visibility that the CCPs give us to the results of the stress test. I wonder, though, should more visibility and potentially input be given to the actual scenarios and the shocks that are run, and also to the jump-off points from which we start the stresses, what market conditions we consider. I agree with Marnie's point that the CPSS, IOSCO disclosures are stepping in the right direction, but still believe more transparency into this area could help us collectively strengthen risk management.
Thank you, Susie. The chair recognizes Lindsay Hopkins.
Thanks, Alicia, and I should be able to make.
I'm sorry.
Yeah, and I should be able to make this pretty quick. My comment is on the governance side. There were a few calls earlier today for more clearing member representation in governance, particularly at the risk committee level. And while I obviously think that perspective is very valuable, it also depends upon the support and involvement of clearing members in the process. I think there's some recognition that there's already a limited pool of experts or qualified individuals when it comes to CCP issues. So then when you have a small exchange like us, that already limited pool is really even smaller. So it just makes any kind of expectation or best practices in terms of representation or composition of committees really difficult. So we appreciate the flexibility that's in the current regulations to determine the best governance arrangements, committee composition, and both of your comments on flexibility as well.
Thank you, Lindsay. The chair recognizes Dimitri Karousos.
Thanks, Alicia. I'll also keep my...
I'm sorry, from Nodal Exchange.
Thanks, Alicia. I'll also keep my comments brief. Just wanted to start by saying Nodal Exchange, for those who don't know us or are familiar with us, we are a commodity exchange in North America. We are the second largest commodity exchange for power futures, so we represent roughly 30% of the open interest in power trading. So, of course, The events in Europe were of particular interest to us and have led to numerous conversations with our clearing members, and so this is all very fresh, of course, for us. We welcome the recommendations that have come from FIA and from the clearing members regarding best practices, partially because we think we already capture most of those best practices. So whether it's directly incorporating concentration risk into the margin requirements for all the portfolios, we've been doing that since launch, or whether in terms of taking on the pro-cyclicality risk, Marnie, that you mentioned, we look back to up to 10 years for specific risk scenarios to particularly capture that, because as you know, we've been through a relatively low period of volatility recently, and if you just jump into that volatility, you will see your margin model react unless you've captured some of that prior historical risk. So while we welcome all of that, I just want to echo the theme of flexibility and not being overly prescriptive. So in two areas, for example, that we would caution, we are quite familiar with the average daily volume formula used by some clearing members and by some clearing houses to calculate liquidity margin or concentration margin. We don't think that's a good calculation. We think average daily volume is more reflective of day trading and in and out trading rather than what we prefer to use, which is a share of open interest. So just in that particular example, I think having the flexibility to determine what the appropriate way to manage concentration risk should be left up to the clearinghouse. And there was another thing I was going to mention, but I forgot already. And then my broader point, I don't want to preempt the findings of the default in NASDAQ. We certainly don't know all the facts. And so I don't want to preempt anything there. I just would highlight that when those recommendations do come out, based on our conversations that have already occurred, our insight is that not all recommendations are created equally. So for us, the membership requirements were of particular concern in that scenario, and likewise, the way the default itself was handled. So we still need to learn more. We still need to understand the overall details and facts. But my suspicion is that what we've already gleaned is that not all the recommendations are as important as others. So thank you for your time, and thank you for attention to this important discussion.
Thank you, Dimitri. The chair recognizes Commissioner Berkovitz.
Thank you, Alicia. There have been a number of comments this morning. Lee and Dale, and I think Salman, you talked about the importance of wide and diverse membership for the clearing houses. And in light of that, and I've seen, Robert, you have a number of other occasions. I've seen your diagrams about the advantages of clearing and the spokes and all the radial lines going to the various members that support clearing. And so my question is, how concerned should we be now when we see some of these numbers, like the FSB is reporting that 5 clearing members have 80% of certain markets, like the interest rate swap market. We're down to a handful, literally a handful of clearing members have about 80% of the market. And is there a point at which there's too few clearing members to support clearing? Are we anywhere near that, or how do we make a judgment on the robustness of the process with so few members?
Lee, your card is still up. You want to take that? Lee Betzel, CME Group.
Captured. To answer the question, I do think there is such a thing as too few clearing members. We do benefit from having a diverse set of clearing members. I would make the point that there is a large area of difference between OTC cleared products and listed cleared products. We find that in the listed business there are a lot more clearing members, and there are a lot more clearing members providing client clearing. Just want to make that distinction. But I agree with your fear that there could be too few firms providing client clearing, and we should be looking as an industry to enhance things like capital rules for banks to ensure that there are a diversification and enough clearing members offering services to clients that we can achieve things like porting of clients should there be a clearing member default.
The chair recognizes Dale Michaels, OCC.
Thank you. Yeah, I think you bring up a great point here. You know, coming back years ago, we had well over 100 clearing members. Those are dwindling over time. That's why we are very cognizant to try to bring in clearing members that may not be the largest of the large members. These smaller members, if they are appropriately risk managed, if we making sure that they have the adequate staffing, the systems, the capabilities, that they are also bringing in clients that just won't be cleared by the clearing members. They may not have the client capabilities that the larger members don't want to have. So they are bringing in diversification to our industry. We need to have more of these members because you mentioned the concentration risk. You talk about settlement banks are the same thing. We don't have a large, diverse settlement banks. We are reaching out to get more settlement banks because there is a concentration of settlement banks. You talk about custodial services as well in the industry. There's we keep on going on and on where we keep on reaching out and trying to find other ways to balance out the concentration risk. So I don't want to get into this thing that as far as, okay, large is the only one that's good. There has to be a balance in here. And just because there might be smaller members that I don't want to equate this to what happened with the clearing member default at NASDAQ, where that was a direct participant. That was a little bit different than just saying it was a small member. We should encourage smaller members to reduce some of the concentration risk as long as we as the CCPs are looking at the financial metrics that they have, looking at the exposures that they're bringing. We're looking at the systems, the staffing, and their capabilities.
The chair recognizes Lee Betzel.
Thank you, Alicia. I did want to circle back to the topic that's been raised by a number of committee members, skin in the game. It seems to be a theme throughout the conversation today, and I'd like to thank the committee member for suggestions on potentially looking at new forms of taking skin in the game. That being said, I do think that it is an important tenet of a CCP that it does have an appropriate level of skin in the game, and that skin in the game is first loss. A number of you have pointed that out, and I just wanted to be clear that that the CME anyway is very much in agreement with that. It should be first loss, and it should be in a form which is immediately recognizable or can be fed into the system. When looking at an appropriate amount of skin in the game, I want to go back to my comments in the opening that it needs to be large enough to incentivize the clearinghouse to get its risk management practices right, but not too large that it disincentivizes clearing members from participating in a productive and efficient way in the default management process. So where that level is a difficult thing to pinpoint, but I think when assessing the size of skin in the game that a CCP has, it's not appropriate to look at the aggregate amount of the guarantee fund. It's more appropriate to look at the amount that's being contributed by its clearing members. It is first loss, or should be first loss before going into the mutualized guarantee fund, and it should be at a level which is commensurate with the amount of contribution that its clearing members bring, and that amount of allocation, if you will, of those contributions to clearing members should be in alignment with the size of the exposures that particular clearing member is bringing into the system. Thank you.
Thank you, Lee. Are there any members on the phone with additional comments or questions? Well, the final comment and question of the day goes to Kristen Walters of BlackRock.
Thanks very much. Just a final comment around skin in the game, and so, if you think about the recent Nasdaq default, just bear in mind that Nasdaq is a publicly traded holding company with $14 billion in market capitalization, and so I don't think it's unreasonable to ask CCPs of that size and strength from a capital perspective to provide reasonable amounts to a default fund rather than potentially having losses allocated to end users. Thanks.
Well, that concludes our very lively discussion of clearinghouse risk management and governance today. Thank you to our facilitators and our panelists and our MRAC members who participated. And at this time, in keeping with the meeting agenda, we will break for lunch. For those of you who are not familiar with the area, we do have lunch options on the agenda table. Should you wish to bring your lunch back, you're able to have lunch in our employee lounge. And Bob Wasserman has graciously baked 2 cakes for the MRAC meeting. So, and everyone knows that Bob's cakes are not to be missed. So the Wasser cakes will be put out at 12:55. So we will adjourn now for lunch and then be back at 1. Thank you so much.
Did it work for you?
It worked.
Oh, good. I think it worked well too. I must admit, I was trying to run the clock out a little bit to get the panelists, to really sink.
MRAC members who are joining us for lunch, can you please see Margie at the table if you have not already paid for lunch? Could everyone please take their seats? We're going to start shortly. It's my pleasure to call this meeting back to order. And now we'll have the second panel of the day, non-default losses and recovery and resolution. Isaac Chang of AQR Capital Management is the facilitator of this panel. Isaac is the managing director and co-head of trading of AQR Capital Management. And in this role, he's responsible for managing the firm's trading operations across all asset classes and regions, as well as ensuring the firm's execution strategy responds to and adjusts with changes to the market structure and regulatory landscape. He's a member of AQR's internal committees dealing with market and liquidity, operational, counterparty, and technology risk. He also sets the direction and priorities for trading technology initiatives, including order management, execution, and analytics. And he's also a member of the MRAC as well. So we're very happy to have you, and thank you, and I'll turn it over to you.
Great, thanks, Alicia. Thank you. I'll start by thanking Commissioner Benham and Alicia also for focusing on this area of clearinghouse risk and putting this meeting together, and also to the chairman and Commissioner Stump and Berkowitz for their support. So I have the privilege today of introducing and facilitating the second panel of the day. We also have the distinction of being the first panel after lunch. So first and foremost, we'll do our best to try and keep people from slipping into a food coma. Generally, when market participants discuss and debate clearinghouse risk, the focus is on what happens in the case a market participant is not able to make their margin requirements and defaults. Indeed, it might seem overly clear that managing the risk of a clearing member is a CCP's core function. However, the topic of this panel is non-default losses, both generally, but also specifically in recovery and resolution. This is an area that, at least based on my observation, is discussed much less frequently and where formal rules are relatively less clear. These losses can be characterized in three broad buckets. First, losses from business or operational failures. Second, losses from investments. And third, losses from custodial failures. Business or operational failures can cover a very wide range of outcomes: a cyber attack, fraud by a CCP, internal technology failure, a regulatory issue. Investment or custodial losses relate to the initial margin that clearing members post. This margin can be in the form of cash or securities. And when cash is posted, the CCP invests cash based on its investment policies, often set in consultation with clearing members. An a loss on those investments would reduce the value of the clearing member's margin and require the clearing member to provide additional assets. When members post non-cash initial margin, that is deposited with an approved custodian. The failure of a custodian could lead to either a delay in gaining access to this margin, or potentially even the loss of a clearing member's non-cash margin. CPMI IOSCO, in their 2016 paper, Resilience and Recovery of Central Counterparties, further guidance on the PFMI, stated that a CCP should identify the amount of its own resources to be applied towards losses arising from custody and investment risk to bolster confidence that participants' assets are prudently safeguarded. Additionally, and perhaps in contrast, it says that a CCP should hold sufficient liquid net assets funded by equity that it can continue its operations and services as an ongoing concern after a business loss. This CPMI IOSCO paper also argues that the general business losses should be the responsibility of a CCP, while it might be reasonable to share custody and investment risks between the CCP and its members. In practice, however, as our panelists will discuss, policies and practices vary across clearinghouse families, and regulatory guidance actually also varies between geographies. The issue of non-default losses can be further complicated if they occur simultaneously with default losses. Additionally, what happens when the loss is catastrophic or large enough to consume all available resources? I think these questions just scratch the surface of the myriad of issues that arise when we start to delve more deeply into the topic. With that, let me turn to my distinguished panelists. I'll introduce each one, and they'll give their initial statement before we proceed. So first, we have 3 representatives from clearinghouses, then 1 from a clearing member, and finally 1 from a buy-side end user. So let me first introduce Theo Flor, Systemic Risk Policy Advisor at Eurex Clearing, and give him a chance to give his opening statement. Theo, the floor is yours.
Thank you very much. I would like to thank the CFTC, its staff, and Commissioner Benham for the opportunity to speak on this important topic. We are strong supporters of the public discourse the MRAC fosters, which is essential for the thoughtful challenge and debate that maintains trust and prudence in our markets. My name is Theo Flor, and I represent a CCP based in Frankfurt, Germany. We are a CCP under EMIR, as well as a credit institution with its applicable regulations in the EU. While the European Union has not finalized its recovery and resolution legislation, this is at an advanced stage, and the European Parliament has finalized its position earlier on this year. And we expect that this will be very much in line with the considered recovery and resolution work developed by CPMI IOSCO and the FSB. Non-default losses are, for CCP, a humbling topic. While recovery and resolution for member default scenarios highlights the ability of centralized risk managers to rematch and recollateralize markets undergoing the most extreme scenarios, the non-default losses are concerned not with resolving the market crisis, but facing our own failures. This distinction is crucial, as non-default losses are those scenarios in which the CCP has a matched book and its members are alive and well. It is thus a question of how resilient the operator of the CCP is, and how centrally cleared markets can be continued with minimal disruption should the operator need to be replaced. This also makes clear the difference of incentives that are key to minimizing the likelihood and impact of non-default losses. While in member default cases, participants require both ex-ante incentives for accepting the costs of prudent collateralization and the in-situ circumstances to support the CCP rebalancing the market, for non-default losses, it is the CCP which requires both forms of control and restraint. Of course, with CCPs exposed to varying degrees of their clearing members or affiliate companies for supporting services, and the links between certain types of non-default losses and market stress, there are joint member default and non-default loss scenarios. A proposed approach to such events is to tackle the member defaults first, and then the non-default losses, if they cannot be separated or managed simultaneously. It would not make much sense to recover the CCP operator if the markets it served were unviable and their continuation was either undesirable or impossible. The second conceptual point, both in terms of fairness but setting incentives, is that as a rule, the CCP should bear the losses for non-default losses. There is one major exception to this, which is for those non-default loss types which relate to the cleared markets themselves. Our approach is that all non-default losses are solely our responsibility to manage, and should the unlikely situation ever arise, cover ourselves. Any loss sharing with participants must be explicitly described in our rulebook, subject to consultation with them and regulators. In our view, this creates a suitable governing arrangement for clarifying responsibility. In particular, CCPs hold cash and non-cash collateral from their members, and risks which affects these must be in some cases shared with the participants. If a non-default loss would encumber the collateral, then the cleared market would no longer be intact as the open positions are uncovered. As such, the non-default loss is not one which a change of operator would cure. There is also the practical consideration that it would be wholly uneconomical for a CCP operator to underwrite the full collateral pool of the markets it clears. For this particular case, our rulebook is similar to that of many CCPs. For those currencies we receive that we cannot deposit at central banks, following a tranche of CCP equity, further losses in that currency would be allocated to participants who gave it to the CCP. While much of the public sector and industry debate has focused on these demarcation questions, most of our time on non-default loss work consists of improving our resilience and validating and challenging our operations and defining the various categories of non-default losses. Thank you, and I look forward to your questions.
Thanks, Teo. Next, we have Eric Neal, General Counsel of ICE Clear Credit.
Thank you, Isaac. I'd like to take this opportunity to thank the commissioners, thank Alicia Lewis for putting together this meeting today and discuss these important topics and allowing ICE to participate in these discussions. I thank you. As Isaac mentioned, I'm the General Counsel of ICE Clear Credit. We are a clearinghouse regulated in the United States, focused on the clearing of over-the-counter credit default swaps. We are also part of the larger Intercontinental Exchange Group. We have 6 regulated clearinghouses across 5 different regulatory jurisdictions. We spend a significant amount of time at ICE coordinating across our clearinghouses for consistent practices, despite at times differing local regulations. Non-default losses is no exception to this coordination, and we do our best to make sure things are consistent unless there's a regulatory reason that they're not. Echoing Teo's comments, in terms of business and operational risk, clearinghouses are responsible for their business operation, their technology, etc., and we are responsible for any losses resulting from those activities. Just like any other business, we are liable for our business and operational losses. If that was the end of the discussion, it would be a quick panel, but there are a couple exceptions to this general rule. And that is in the context of investment losses and custodial losses. If you think about what a clearinghouse does, a material aspect of its business is to collect significant assets from its clearing members in the form of margin and guarantee fund deposits to support their cleared positions. ICE Clear Credit is not a bank, it is not a custodian. We don't have the option of simply holding these assets. We need to rely on third parties to provide services and also third party as investment counterparties. This activity there's significant constraints on what we can do with these assets due to regulations which are appropriate given the systemic risks involved. If central bank depository services and custodial services are available, they should be fully utilized. That type of access largely mitigates these custodial investment losses facing clearinghouses. But to the extent that central bank access is not available, CCPs must rely on commercial banks and custodians. So there's options. What happens if there's a loss related to those services provided by these commercial institutions? And I wanted to go through a few of the options to just compare and contrast. It's not uncommon when you use the services of a third party that's outside your control to disclaim responsibility for those third-party activities, absent violation of some standard of care, fraud, negligence, willful misconduct. So there is an argument that clearinghouse could disclaim liability for third-party service providers. And that's not inconsistent with similar actors within the financial system. At the other extreme, clearinghouses could be fully responsible for the activities of these third-party actors, regardless of whether there's a breach of any type of standard of care. This would, in effect, make clearinghouses the guarantor of these highly regulated financial institutions. That's a position that may impair the resiliency of clearinghouses. A middle ground, and this is the position advocated by CPMI IOSCO, is that there's some sharing of this liability, and that the clearinghouses assume a first loss liability layer prior to mutualizing to the clearing members. This is an approach that's supported by ICE. And this is essentially is not, there is an absence of regulation in this area with one exception that I know of. So this essentially is a business decision at this point of the clearinghouse to assume this first loss layer. ICE, as I mentioned, has multiple clearinghouses. Some of them have this type of loss layers in place already. Other clearinghouses are actively working with local regulators to put that type of first loss liability in place. Another related topic, which when we're talking about non-default losses that I think is important to keep in mind, is the capital resources available at the clearinghouse to pay for any type of liability. Depending on what jurisdiction the clearinghouse is sitting in, regulatory capital requirements can be very different. For example, in the U.S., you have essentially a 12-month projected operating expense capital requirement imposed on CCPs. In Europe, you have the EBA standards for capital requirements, and those calculations can come out to very different results. So depending on what jurisdiction in, you may have a regulatory requirement that are very different about what resources are available to ensure the resiliency of the clearinghouse. And when talking about non-default losses and talking about liability for non-default losses, I think it's important to also bring in the analogous concept of CCP capital requirements. I'll leave my comments at that. I thank you and welcome any questions you may have.
Thanks, Eric. That brings us to Dennis McLaughlin, Chief Risk Officer of LCH Group Limited.
Thank you for the opportunity of addressing the Commission today. It's probably worth taking a step back and just see how this all fits into the scheme of things. The so-called default losses are traditionally what CCPs had to manage, and they were set up to handle the member default, a default of a clearing member. There are other losses, however, that are not directly related to that you incur when trying to carry out that function. So for example, you have to take margins that the members give you and find a home for them because you're not allowed to keep it on deposit at a commercial bank, for example, which is very wise, but what do you do with them? Well, there are all sorts of regulatory constraints about how you can invest that margin. So for example, you can't keep, under EMIR, you can't have more than 5% invested unsecured. So what do you do with the rest of it? You have to go to the repo market, unfortunately. So you're exposed to investment losses in order to fulfill your function to have the margin ready in the event it's needed to cover a member default. Now, if you have access to a central bank in the relevant currency, then you can just pass through the money that the client gives you directly into the deposit account, and you can avoid taking that investment risk. And indeed, that's what we do in the Paris CCP, where it is a financial institution, has full access to the European financial system, and therefore we don't incur investment risk in the same way. However, in London, in our London clearinghouse, we manage 22 different currencies. And of course, we don't have deposit accounts in each of those currencies. Most notable is the US. So we're forced into the repo market and to manage the investment activity in that way so that our liquidity profile is such that we can have enough money to cover the default of a clearing member. What I would say about that is it can be also mitigated in many ways. Probably the easiest way to mitigate that is to make sure you have a very narrow, high-quality list of collateral that you would accept so that you do not experience a deterioration in the credit quality of that collateral. That's the primary defense. The Bank of England, a few years ago, introduced regulations, or it's a statutory regulation, where they forced such a clearinghouse to have a loss allocation procedure agreed with its members. And so we indeed have that in place, where we take a skin in the game, and above that skin in the game, the investment losses are shared out among its members. That's the primary way that we handle losses for from investments at LCH. The other biggest ones are when an ICSD fails. So we've heard about the custodian failing. Well, a custodian, we have legally segregated collateral. We don't have to have a default of the custodian. We just have to have an operational problem. And therefore, it will be difficult to get our hands on the collateral in order to then turn around and turn it into cash. So it is legally segregated. That's probably a very big risk that we have to manage. But if the custodian is in trouble, then it's a market-wide issue. It's not just us, because many people are using these custodians. The same with an ICSD, the settlement platform. The biggest example I can think of is probably Euroclear in Europe, where it's the mechanism by which we breathe in the market, which turns securities into cash, and which we all then get the cash that we so want. If there's an operational failure there, then we'd have a delay in getting our hands on that cash, and there could be some slippage in the market. So these are primarily the largest kind of in non-default losses that we face. People have also asked about cyber. Cyber is a non-default loss. It fits into the general operational losses category, and we would agree, of course, that for such losses, it comes down to the clearinghouse capital at the end of the day. The biggest risk in cyber is really the margins that our clients, our members give us, need to be protected against a hack, for example. And if you have that locked down, which it is possible to do, then any resulting losses would be immediately or very quickly detected, because each account is being reconciled by up to 3 to 4 different institutions several times a day. So we would detect an anomaly in the data from a hack very, very quickly. And then it's all about resetting the clock to the most recent, fresh, good data set and running on from there. And since we're subject to the 2-hour recovery, we're talking a small number of hours to recover from a cyber attack. So they're the defenses, if you like, that we have in place to cover the major types of non-default losses. I'll stop there.
Thank you, Dennis. So now we move from clearing houses to clearing members. Next up is Biz Chatterjee. He is Managing Director and Co-Head of Electronic Trading and Automated Market Making for the Global Spread Products Group at Citigroup. Biz.
Thank you, Isaac. At the start, I'd like to acknowledge, obviously, Commissioner Benham, sponsor of the NBRAC, for giving us this opportunity. I'd like to thank the chairman, the other commissioners of the CFTC for their continued support for making this forum successful. Finally, thanks to Alicia for her tireless efforts, including yesterday 8 a.m. when she was trying to juggle 2 calls successfully for prepping the panelists. So starting at a high level, as acknowledged by the other panel members, non-default loss, or NDL as it's being started referred to, is described as losses sustained by clearing ecosystem from sources other than related to the positions of a defaulted clearing member. I'd like to stress ecosystem and not CCP, because I think these losses could be borne by the CCP, these could be suffered by the clearing members, and it could be suffered by our clients. Sources of NDLs, Isaac mentioned 3 sources. I'd like to add a 4th one. So first is obviously investment of collateral. Second is failure of financial services provider. The third is operations, IT, cyber, fraud. The 4th loss, which I can identify, is that may be resulting from unexpected monetary downside from fines or regulatory actions, and that can sometimes be a significant source of NDL as well. So before we jump to the topic and move to identifying who's responsible and allocating these losses, I would really like to emphasize that our view on NDL is it's a unnecessary loss, and our focus should really be on trying to prevent NDL. And the responsibility of preventing NDL should be the entire responsibility of the ecosystem, whether it's the CCP management team, the clearing members, or the clients. For example, in the case of cyber, a lot of times the attack or the hack may come from the extended ecosystem and find its way to the clearinghouse. So the clearinghouses may have in place very robust, defenses, but it's always the weakest link that exposes, the system to NDLs. And as we enter into, this age of rapid technology and operational innovation, we're obviously opening the door to such threats. As a result, we feel that transparency, having an open dialogue with the CCP and its members, and spreading the awareness about NDLs, the source of NDLs, and how such NDLs can be prevented should be the focus of our discussions across the industry. When it comes to responsibility of NDLs and the associated loss allocation from these above sources, I think there's various issues that are involved in trying to identify, who are the parties that were making these specific choices that led to these NDLs. Were there available alternate options? I think some of my fellow panelists mentioned that in some cases like custodian banks, there aren't that many options available. The transparency that was provided to the members and our clients about, these choices that were being made, whether they're investment, whether they're custodial, and if there was any financial upside from making these choices regarding investment decisions, and who was bearing the benefit of these upsides. So I think a lot of these factors would go into deciding who bears the loss and how these losses would be allocated. So depending on the issues associated with the cause of these losses, the NDL could be broadly borne by the clearing members and the end users, the CCP, or jointly by the CCP and its membership. To generalize, I think when clearing members make distinct choices like those related to investments, it's probably fair that these members bear some of these losses, because especially if they were earning the benefits and choosing a certain type of collateral investment and earning that return. Similarly, losses where CCP day-to-day management operations are resulting from choices made by the CCP management, it might be possible to point those losses back at the people making such decisions. And where the CCP activity relies on third-party custodians, third-party service providers, and where, like I mentioned, these service providers aren't there in abundant supply for you to make these choices or transfer as you sense a weakening, these losses could possibly be borne jointly across the system. Finally, where do we get the resources for curing NDLs? And I think on this point, we feel strongly that resources for NDLs should be distinct than those that are available for curing member default. The current default management frameworks, whether it's the IM or the guarantee fund models, do not include any factors for modeling of NDLs. So it would be probably not wise to directly jump into and start using the default management funds to cure NDLs. So rather than combine these two complex risk models, we think it's probably better to consider modeling the NDL losses and therefore coming up with a source of resources separately. At the same time, we have to recognize that additional resources, if they are kept against losses, obviously add cost to the clearing system. So if we choose to explore options on separately resourcing and funding such NDLs, we should also be cognizant about whether we can be creative about creating the source of these funds for NDL, whether they should be funded or unfunded, such that the costs of such resources are appropriately borne. With that, I'd like to close and thank you, everyone.
Thanks, Biz. So now we hear from an buy-side end user of clearinghouses, Eileen Kiley, she's Managing Director from BlackRock. Thanks, Eileen.
Thank you, Isaac, and thank you very much to the Commission for inviting BlackRock here today to provide these thoughts. Before I make my comments, I'd like to remind those listening, since I know this is being webcast to whoever is listening, that I am sitting here as a fiduciary today on behalf of BlackRock's clients. BlackRock itself does not take any economic risk to central counterparties. and our comments today are entirely aimed at what we think is best for the end investor. And these are investors who are saving for their educations and retirement across the globe. And in order to comment on non-default losses, I think we must first start with our position on default losses, which will help frame our view on the NDL. Default losses should not be allocated to the end investor unless it is done so by a resolution authority. This position rests on the premise that central counterparties are in the business of credit risk mitigation. They offer the service of credit risk mitigation for a fee. And I think we'll all agree this has proven to be a very profitable business, and I think we cannot lose sight in that as we continue to regulate this industry. If a CCP fails in its provision of credit risk mitigation, then it itself should be allowed to fail. And if the resolution authority finds it in the public interest for the central counterparty to continue operating, then that resolution authority should allocate losses accordingly. Any losses paid by participants in this process should be refunded out of future profits of a reconstituted central counterparty. So given this position on default losses, I think our position on non-default losses is fairly straightforward. At no point should non-default losses be passed to the end investor, whether they are corporate losses, investment losses, or third-party related losses such as custodial failures. I will justify this position by addressing a very reasonable connection between decision-making and loss-bearing. As an end investor, we have no say in how the central counterparty uses our clients' cash or securities. We rely on the various client money rules around the globe that generally provide protection against inappropriate investments. But the investment decision is ultimately made by the central counterparty, or in some cases, our clearing member. Similarly, the choice of custodian or payment bank is usually made by the central counterparty or the clearing member. We expect these entities, as our service providers, to fully vet and risk manage the third parties they select. In that regard, we believe the current legal framework may be too ambiguous about how clearing members may be able to allocate losses to investors. Standard industry documentation tends to provide intermediaries with pretty broad leeway to pass losses on to their clients. So as we collectively strive to enhance the safety and soundness of our markets, we think this is something that should be reviewed closely. Thank you for your attention, and I look forward to the discussion to follow.
Yep. Thanks, Eileen. So maybe I'll kick off the discussion with a question for the panelists. So given the current state of both differences among details on how clearinghouses handle non-default losses, and given the somewhat unclear regulatory framework, maybe an obvious question to ask is, does the industry need more prescriptive and clear regulatory guidance to ensure the appropriate policies for handling NDLs across clearinghouses?
I can at least take a stab at answering that. Obviously, the answer is yes, but I think there's something we can do immediately, which is, we've been doing it now for a few years, is to start expanding the scope of the fire drills we run outside of regular traditional default losses into non-default loss scenarios. So this is something that it's kind of being done in a very disorganized way already by most CCPs, in the sense that the IT department would run a cyber loss scenario. There might be a fraud scenario run by the finance group. But if you bring it together, you can quickly see that there are some trends here that you can really, or weaknesses that you can isolate. So for example, we've run scenarios on a ICSD being in trouble, not defaulting, but just being in trouble because of the operational and the liquidity implications of that can shed a lot of light on how we run it as an operation. So just those kind of exercises. Another one would be a cyber event. So we've done several of those. For example, an instantaneous default in the normal sense, just called at random. Things like that, unannounced. We've done a lot of those things to test the resilience and to test the controls. So I would say that it would be very helpful if there was a way that we could expand fire drills to mean fire drills for non-default losses, which is something that we should do anyway.
The chair recognizes Eileen Kiley from BlackRock.
Thank you. So I think I'd like to make a comment that ties together what we were talking about earlier this morning, and that's the importance of just a capital framework for CCPs in general. I think non-default losses and default losses need to have more stringent, a more reasoned and thoughtful foundation upon which capital should be held against them. So, non-default losses have default losses have a more stringent approach right now. Non-default losses are much further behind, but they both really do need to have a more fulsome approach by the regulatory community.
The chair recognizes Teo Floor, Eurex Clearing.
Thank you. I would agree with Dennis that yes, of course, we'd need further sort of regulatory guidance on the matter. I mean, not only because it relates to how recovery and resolution is handled in general. So in Europe, that's still an ongoing discussion. I think that for NDL cases which potentially bring the whole CCP down, of course, there's an important question of who our resolution authority would be in Europe and how they would interact with our supervisors if they're not the same. I would contend that there is quite a lot of commonality in how CCPs actually approach the topic. So from that perspective, I'm not sure whether there's too much divergence in how it is handled in practice. The one question, of course, which stands out is the ability of different CCPs to access different central banks or different CSDs. And I think that that's an area which, of course, is very controversial. It's not one that we can ourselves, I think, tackle. So I think that's an area where if regulators decide what they want the ability of CCPs to access central banks to be, then it becomes relatively easy to make sure that we all have sort of commonality in how we treat any potential sharing of those NDL losses.
I'm going to open up the floor for questions and comments, but I'm going to go to Chairman Giancarlo first.
Thank you. I thought Isaac's question was a good one, and I find it remarkable that at least 3 of the respondents immediately said government response is necessary. I would have thought that just good enterprise risk management practices, good risk mitigation controls within your own firms would have led to a way of addressing this before we need to get to a prescriptive approach from regulators. Is that not the case? Is that not the case that good risk management at CCPs would have led to a first step before regulators need to come in with a prescriptive approach to handling that?
Okay, so where do I start? All cards are up. Okay, we'll start with Biz Chatterjee.
So
from Citi.
I think, Chairman, you stole my thunder because I was going to respond to the previous question. Certainly, I think it's very hard to see the market asking for more regulation. So I think there's a whole spectrum. You start with guidelines, you move to policy, and then maybe regulation. And I would kind of put this discussion and this topic in the kind of guideline phase so far. And I think there are a couple of things that can easily address this issue. Transparency. I think Teo mentioned about their clearinghouse having it very clearly laid out in their rule books. I think that would be the first guideline as good management practice every CCP or the clearing ecosystem can follow. I think the challenge with NDLs is it's something that takes everyone by surprise. No one expected an NDL and therefore ends up with an NDL. And therefore we're all scrambling, trying to figure out. So I think transparency, better clarity would definitely solve a lot of these issues. Going back to resources, capital, as it is with market risk, credit risk, we're having a challenging time trying to identify the right capital associated with default losses. modeling non-default losses is going to be an extremely challenging thing, and I think it would take probably very non-traditional methods of trying to get to model. So I'm firmly of the belief that we should give the guideline and policy and transparency efforts a shot before we ask you for regulation.
Thank you, Biz. I'm going to go to Eric Neal before I go to the MRAC. And then Dennis and Teo, I'll come to you guys after we do the round robin with the MRAC.
I just wanted to be clear that I did not advocate for additional regulation, just to be. And the additional regulation, it's difficult because a lot of the focus that we've had in recent years has been the resiliency and the survivability of the clearinghouse given their systemic concentration of risk. And this issue kind of cuts the other direction a little bit. And Chairman Giancarlo, yes, we do have extensive enterprise risk management. We're doing a lot to mitigate these risks, but I don't think that's ever going to eliminate the possibility that there's still going to be a non-default loss. And so we're still going to have this discussion. And the survivability of the clearinghouse, as opposed to who bears the liability of these losses, that's a conflict at times, and that's why the regulation is challenging. But the reality is where we are today and what CCPs have adopted. In Europe, there is a regulation related to investment losses. Guess what? All the clearinghouses have some type of loss allocation system in place in reaction to that regulation. In the absence of something specific, it's a little bit more hit or miss. So I think that kind of answers your question.
Tyson Slocum, Public Citizen.
Thank you. I've got two quick questions, if I could. Mr. Chang laid out, I guess, 3 categories of non-default losses, and Mr. Chatterjee offered a 4th. Just to give me an idea about which ones are driving most of the non-default losses, is there any one of those 3 or 4 in particular that is a larger share of those losses, or does it really just depend upon the market or whatever? And then second, Mr. Chatterjee, you talked about cyber hacks or other types of cyber breaches resulting in non-default losses. What are the current disclosure requirements by CCPs to report breaches to the Commission, regardless of whether or not they result in non-default losses? Thank you.
The chair recognizes Bish Chatterjee, Citigroup.
Thank you, Tyson. I'll take your first question. The scale of the losses, that's why I mentioned it's really hard to model. If you take something like investment losses, you could have modest investment losses that may be a few cents to $1. I understand a few cents may be a large number for some people, but and that just is a nature of the loss. Something like cyber, especially if it's fraud or stealing of funds, could be in larger amounts. But if you compare that to the probability and the number of times that happens, it's probably very few times that so you have events that may happen on a continuous basis. You may lose a few cents on investment, but more frequently, and that may not really trigger a massive problem to the CCP ecosystem. But you could have a one-time event in 5 years where you have a cyber fraud, and that could run into hundreds of millions, and that could probably shut down the clearing ecosystem. So that is really the challenge with non-default losses, is their unexpected nature and how and when in what magnitude they occur and how much they are in your control. The other thing I would like to mention about cyber is people immediately focus on funds being stolen. Actually, if you follow the cyber area, there's a lot of malicious attacks that just people are doing for fun to corrupt your system. So they may come in and corrupt your margin models. They personally might not gain anything from it, except just take some pleasure in just having an operation go crazy. So cyber is very unusual, and therefore, again, very hard to model. On your second question, I'd rather let my CCP panelists handle it, because they probably have a better idea about their interaction with the regulators in that aspect.
The chair recognizes Teo Floor, Are you going to respond to the second part of the question regarding reporting? Okay.
I didn't see anyone else put up their 10, so I thought I'll take a stab at it. I think this partly answers the question from Chairman Giancarlo. There aren't major NDL losses, at least not in our CCP. I mean, these are really minor claims that on occasion occur for operational reasons. So in a very practical sense, the losses, they don't occur. We're talking about very theoretical instances. For the little ones that do occur, those would be in the first bucket. For the ones that I think are the major ones, those would be in the second and potentially the third one. In the third one, that really depends on the custodial arrangements. In our case, if securities are held in CSDs, then they probably won't be moved out. So it's just a question of timing until we have access to them again. It's really the cash investment losses where the size of the market that the CCP clears is much larger than the CCP itself. They're relatively small corporations. And in terms of recovery and resolution scenarios, if there was one of the first type that would destroy the CCP and the operator would need to be replaced, then those are relatively small amounts in terms of financial corporations. We tend to be sort of mid-sized to at best large companies, even for the entire group that typically includes different services too.
The chair recognizes Eric Neal, Ice Clear Credit.
And to add on to that, and I'll give credit to the CFTC since we're sitting in their lovely building. I mean, we do have extensive event-specific reporting obligations to the CFTC for system failure, cyber attacks, whatnot, regardless of whether they result in any actual losses, which we don't have. This is a theoretical discussion. We don't really have non-default losses, but if so, it's all system problems are all reported to the Commission and other regulators. And to get back to another related topic about these different types of non-default losses, there's a piece in the IOSCO guidance regarding, they're advocating for a first layer loss of investment and custodial losses, which we agree with, but they're also advocating that those assets be ring fenced, that they can't be used for any other reason at the clearinghouse, even another non-default loss. This might be my personal opinion. I'm not sure that is the best position. In speaking to our members, speaking to our market participants, when we talk about non-default losses, it tends to be the cyber type of scenarios that they get the most concern about. This is something that is solely within the responsibility of the clearinghouse, and to take assets off the table that are not available for that type of loss may be short-sighted, especially if you're assuming we're in a limited resource world.
The chair recognizes Salman Benai.
Thank you, Alicia. I just wanted to emphasize something that's been just implied in some of the discussion so far. When we think about non-default losses, under that header we have operational risks, and we talked in the previous panel about market risk stress testing. May be advisable for the industry to also coalesce around new ideas, best practices for operational stress tests. And insofar as we're an authorized non-execution venue trade source for trades that are cleared and settled at a clearinghouse, we would be more than happy to participate in that type of activity.
The chair recognizes Kristen Walters, BlackRock.
Thanks, Alicia. So I think to Commissioner Giancarlo's questions about enterprise risk, I think there's a direct link to just basic accountability. So as an asset manager, BlackRock is paid by clients. We are paid fees to manage assets and corresponding market liquidity and credit risk in a way that's consistent with the client's expectations as outlined in a mandate. As part of that, we are also, implicitly and explicitly expected to manage enterprise risks that we're exposed to as part of our investment activities. That includes operational risk, technology risk, cyber, reputational risk to the firm, and third-party risk. And third-party risk, it's difficult. It's more difficult to manage than direct risk. For us, we need to manage risk. In the real asset space, we hire third parties to manage assets on our behalf, but we're essentially responsible for how those assets are managed. We're expected to have proper risk mitigation over third parties. With index providers, and we have over $6 trillion in assets that are held in custody by third-party custodians, and we own that risk, and we're expected to mitigate risk. And our, BlackRock's risk management team, of which I'm a part of, spent a lot of time looking at enterprise risk as well as traditional fiduciary risks. So what I would say is, on the CCP side, CCPs are paid to mitigate credit risk, but you're not limited to mitigating credit risk. And as my colleague Eileen mentioned, CCPs do generate significant profits, and the expectation is that CCPs would also seek to mitigate third-party risk in the same way that other financial firms do in markets. And I think there are a number of established guidelines that are kind of bring common sense and diligence around how to manage these risks appropriately.
Dimitri, you had Dimitri Carusos from Nodal.
Thank you, Alicia. Chairman Giancarlo, just a quick answer to your question about additional government support or government help. So, of course, we have risk mitigation practices in place with our ecosystem. But as one of the smaller clearinghouses, one of the disadvantages we have is that we don't have access to the central bank. So it would be an advantage for us to reduce something that we consider a relatively remote risk of custodial failure, to almost eliminate it by having the ability to directly deposit. We are sub-Part C DCO, but not systemically important as designated by the Fed, and so therefore we don't have access. And I know that's not a wand that you can wave. I understand that requires legislative action, but that still includes the government. So that's the support we would like. Thank you.
Let's see. Like, where do I go next? All right, the chair recognizes Eileen Keeley.
Thank you. I also wanted to respond to the chairman's comments about, his rightful surprise that we're all sitting here asking for additional regulation. And I think it's important to make this comment for the record that we generally believe that market forces will drive the right outcome, but we're talking about monopoly operators, and market forces don't generally operate as expected when you were talking about monopoly operators. And we do not have another option. If we can't just choose not to use one of these CCPs around the table. We're mandated to use them. We don't have an option. So I think that's just important for the public record to put that out there.
The chair recognizes Dennis McLaughlin, LCH.
Yes, again, just responding to the chairman's comments. There are some instances where, of course, we're working as hard as we can on enterprise risk management, but there's only so far we can go. So one example of that is that we interact with other PFMIs, whether they be ICSDs or data providers, for example, that can be PFMIs, where we operate to different standards than they do. So, for example, we operate to a Cover 2 standard. They might be operating to a Cover 1 standard. So it would be good to have some kind of consistent expectation of what is the risk management standard we're working to. The second one is the reporting is very, very inconsistent across, and even you've mentioned that, across various institutions in terms of what we actually show, what we actually recognize internally as risk. And right now, for example, in the UK, the Bank of England has starting to lay down what needs to be disclosed in measuring the strength of your control environment, which is actually very, very helpful. So at LCH, we run what we call a materiality matrix, which is an objective measurement which can be standardized, but it's adapted to a CCP, which really measures all the incidents that we've had. And of course, as you know, if you were to follow the operational risk categorization under Basel, basically everything in a CCP will fall in one bucket, which is useless. There's no granularity at all. So that might be helpful. And the other way that regulators could be helpful here is, as I mentioned, a large part of the investment risk can be avoided if there is access to a deposit account at the relevant central bank. And obviously, that's not within the CCP's control.
The the chair recognizes Marnie Rosenberg, JP Morgan.
Thank you, Alicia. I'd just like to reiterate Kristen and Eileen's points of BlackRock, which is, from a JP Morgan perspective, we believe that clearinghouses should be accountable for covering the losses arising from non-default losses, since they make the risk management decisions about how to manage the operational risk. There are very few, if any, instances I can think of where clearing members make a decision about how their cash should be necessarily invested. So I wouldn't say clearing members are accountable for those decisions generally. There may be one or two instances somewhere in the world that is the case, but I think as a general matter that isn't the case. I would also say that from a capital perspective, defaulting, no pun intended, to the 12 months of operating expenses just doesn't seem sufficient to us and doesn't seem necessarily robust enough to cover the potential losses from some of these types of events. Thank you.
Are there any questions and comments from members on the phone? Isaac, do you
Not
have
from me.
Oh, I'm sorry.
Not from me. Sorry.
Thank you.
I think this has been certainly a very interesting discussion. I think for all of us, I think we're just really, I think I too was initially surprised by the answer to the questions, but now that the answers have come back, I think there's some very sensible ideas at the very least, particularly around sort of funding of last resort in catastrophic situations that are certainly worth thinking about and exploring. With that, I just wanted to thank each of my panelists for participating today. Thanks.
And that concludes panel number 2. Thank you, panelists. Thank you, Isaac. And now, can I ask that the speakers on panel 3 come forward and take their seats at the panelist table? And now we will have the third panel of the day. As has been mentioned, the central clearing of standardized OTC derivatives is a pillar of the G20 leaders' commitment to reform OTC derivatives markets in response to the financial crisis. Post-crisis reforms include mandatory clearing requirements, capital liquidity and margin requirements relating to OTC derivatives, and reforms relating to resilience, recovery, and resolution of CCPs. These reform measures and the effects of them are the subject of several recent reports, proposed rules, and discussion papers by global standard-setting bodies and prudential regulators, which the panel will discuss. With that said, I'd like to introduce our panelists for this afternoon's panel. First up, we have Sai Srinivasan, Deputy Director, Risk Surveillance Branch of the Division of Clearing and Risk. Sai was the co-chair of the Derivatives Assessment Team, which produced the FSB, CPIM IOSCO, BCBS report on incentives to centrally clear OTC derivatives. Sai, would you like to start?
Thank you, Alicia. Also, I'd like to thank Commissioner Benham and Alicia for inviting me to present the DAT report at MRAC today. After having spent more than 15 months working on the report, it's good to take a chance to sort of talk about it and publicize it a bit, I guess. I'd also like to thank Chairman Giancarlo for all the guidance and support, including tolerating my absence from the chairman's office for weeks together at a time. Before that, my remarks are that of my own and not that of the commission or the commission staff, and neither are they the comments of represent the views of the Financial Stability Board or members of the DAT. So we call the current DAT report, the 2018 DAT report, as DAT 2.0. DAT 1.0 was published in 2014 at a time when the major portions of the G20 reform efforts were still in advanced stages of design and implementation. And interestingly, DAT 1.0 was made up mostly of banking regulators. There was just one market regulator who was part of that report. So, fortunately, DAT 2.0 had a good mix of banking and market regulators. It was also co-sponsored by BCBS, IOSCO, and CPMI. So a lot of brain damage went into finalizing the report. But it's all good work. We were tasked with assessing the interaction of the impact of the interaction of capital, margin, and clearing rules, sort of the key 3 prongs of the G20 reform efforts, on incentives for firms to clear OTC derivatives. While we stuck mostly with OTC derivatives, we also made sure we looked at the broader landscape of exchange-traded derivatives. I'll quickly sort of summarize the findings and then talk about some of the process issues, learnings, and next steps. We found that the reform measures incentivize large financial institutions, the ones that transact actively in the global derivatives markets, to clear centrally. This is important as these institutions are core to the global financial system and key in the sense that they serve as critical transmission mechanisms when there are shocks to the financial system. So to the extent central clearing helps mitigate systemic risk, the reforms are doing a good job. So we got it right. The driving factors are different in terms of the factors that are incentivizing the firms. For large global banks, the banks are incentivized by the margin rules and the capital rules. For non-banks, interestingly, when you say non-banks, asset managers and hedge funds, it's mainly liquidity considerations which are driving the incentives to clear. Central clearing helps aggregate liquidity and sort of lowers transaction costs. So if you're trading actively in the marketplace, those are key considerations. But the reform measures are less effective for firms, either big or small, who are less active in the derivatives markets. If you're less active, then liquidity considerations are relatively less important. Rather, you're more worried about finding a clearing member who will accept your business and help clear your trades. Once again, we also looked at not just the client side, we also looked at the clearing firms. And we, as has been discussed at various MRAC forums, clearing firms in the OTC derivative space are all affiliated with large global banks. And what we found is that they are disincentivized both by capital rules and other non-regulatory factors. When I talk about non-regulatory factors, there's more work to be done, and I'll talk about it in a little bit. But what we identified was there were high fixed costs with offering client clearing services. So in a nutshell, firms who are in the core of the system, incentivized to clear, firms who are on the periphery of the global financial system are less incentivized by the reforms to clear centrally. Few words on the methodology and the process. Conducting impact analysis on large-scale reform efforts is a non-trivial job. It's very, very difficult to do. There are no textbook models that you can follow. The FSB has come up with a framework to do the impact analysis, but it's still sort of work in progress. We relied on a range of different inputs. We did qualitative surveys, quantitative surveys. We took fair amount of technical assistance from market participants, many of who are represented here in this room, to help us sort of design the questionnaires. We also had extensive interaction with the market participants, both in US, in Europe, as well as in Asia, as we were coming up with the methodology. We published a draft consultation and got some good feedback. And most important, I always say we have a lot of data, but we're dumb data. We really need the feedback from market participants to understand how to interpret the data. So it was I really appreciate the support we got from market participants. We also relied extensively on regulatory data because core focus of the reforms was also to get regulatory reporting to the various authorities. And in the report, we talk about some of the challenges with using the data. There's some more work to be done. More in terms of process and also sort of learnings that we have tried to capture in the report itself. As I said, we had the DAT was made up of both of staff from both market regulators and banking regulators. I spent a fair amount of time here at CFTC working on implementing the Dodd-Frank reform rules, so very vested in it, not very educated about capital rules. And there were a bunch of banking regulators who had spent a lot of time working on supplemental leverage ratio and Basel III rules. So we collectively learned a lot about both the macro-prudential rules as well as the micro-prudential rules. A huge amount of learning about, I've been in the derivatives business for a while now, and I still managed to learn a lot about the client clearing business. One of the things we discovered was that as an economist, we believe that there's always a market clearing price to clear a product, but for client clearing, there isn't a market clearing price. On that, we wanted to go and ask the firms, can you tell us, as part of the survey, how much do you actually charge to clear a standard 10-year interest rate swap, of fixed float interest rate swap? The firm said, please don't ask us that question, we can't give that to you. So after doing all this work, I still don't know how much it actually costs for a client to clear a swap. But what we focused on instead was, what's the sort of all-in cost for clearing a swap? From a CFTC perspective and the staff perspective, as I said, we spent a lot of time understanding the derivatives markets and the client clearing business. We also learned a lot about the leverage ratio, about SEM and SACR. I remember a comment from Dale Michaels a couple of years ago, about a year ago, where there was a comment that just that particular week that MRAC was meeting, the FCM had let some of the clients go. So we've done some interesting work here, which is available in the public domain on SEM and the way it's impacting and the exchange-traded derivatives markets. We also leverage the work, the data that we have to understand SACR and aspects of the what I call the miscalibration of SACR, which could have unintended consequences in terms of impact on the markets. There was extensive debate within the DAT in terms of the trade-off between financial stability, or what I call institutional solvency, and market functioning, and we tried to bring some of that debate and consideration into the report. We also spent a lot of time talking about what I was hinting at earlier, the interaction between regulatory and non-regulatory factors. So there's this question that we kept asking, which is, what will happen if this, hopefully not a hypothetical question, if and this goes to the point that Commissioner Berkowitz raised earlier today, was the fact that there's concentration of clearing among a handful of clearing firms. So even if all the capital rules are, the inefficiencies and the miscalibration is fixed, will we see the concentration go away? Will this be sufficient to sort of incentivize more firms to banks to sort of enter into clearing? We can sort of I can speculate, but there's some interesting, some more work to be done. In terms of next steps, DAT's mandate was very clear. We were not asked to make any policy recommendations. So we sort of drew the line there, and we're very careful in not asking the various standard setting bodies to do specific things. Instead, what we did was we highlighted various areas where we thought that the rules were not, the standards and the rules were not we were not robust enough and ask very leading questions that an intelligent person can sort of look at them and figure out, well, this is an area where we need to do some additional work. The Basel Committee had a parallel effort where they were looking at impact of the leverage ratio on client clearing. There was a fair amount of coordination that happened with them. They published a consultation, and the hope is that market participants will sort of help them push further on that effort. IOSCO and CPMI and the other standards setting bodies, my presumption is that they're looking at our findings, and we should all be sort of waiting to see where they land in terms of further work and analysis. So I'll pause here, and if folks have questions, happy to take.
Thank you, Saeed. And now we'll have Marcus. Why did I just forget your name? I know. Marcus Stanley, Americans for Financial Reform Policy Director, and he'll bring us the public interest perspective.
Thank you very much, Alicia. I'd like to thank Commissioner Benham, Chairman Giancarlo, for permitting me to participate today, and also for your great work, Commissioner Benham and Alicia, on putting this event together and doing a really great job on managing the MREC. As Alicia said, I'm the Policy Director for Americans for Financial Reform. We are a coalition of several hundred organizations working for a stronger and more effective financial regulatory system. So as Alicia said, I do bring a public interest perspective to reading these rules, and I'm not going to focus on summarizing the details of the rules, but just kind of offer some responses. We have a lot of papers that this panel is nominally reviewing, but at bottom, all these diverse papers address one issue, which is the backstop resources available in the cleared derivatives ecosystem. Higher levels of backstop resources will reduce systemic risk, but they also increase the total cost of cleared derivatives to market participants. Prior to the 2008 crisis, resources backing derivatives were far too low. Starting in 2001, notional swap volumes grew fivefold in just 6 years, an annual growth rate of 32%. As markets came under stress, these notional volumes were reflected in a massive growth of actual credit exposure. $3 trillion in new credit exposure appeared on the books over just over 2007 and 2008. The resources were simply not there to handle that derivatives exposure. It seems clear that swaps received an implicit safety net subsidy before the crisis. It's therefore appropriate that post-crisis regulation increase the private sector resources backing swaps and thus their overall cost. This both makes the system safer and incentivizes a more economically efficient level of derivatives transactions. Of course, mandatory clearing is a key tool in doing that. But clearing is not an end in itself, it's a means to reduce risk. An under-resourced clearing system will simply be a concentrated node of systemic risk. With that as a background, let me offer some specific comments on these proposals. Multiple proposals address capital held against cleared derivatives by clearing members. It will always be possible to question risk metrics at the position level, and we could get into a very technical debate about the SACR calibration and the CEM and so forth. But I don't think that this position level discussion can or should be separated from the general question of clearing member solvency. Clearing member solvency is critical to the issue of CCP resiliency. Under current rules, clearing members must hold capital against individual positions and also some capital against their share of the default fund. But other mutualized risks or exposures beyond the default fund are not capitalized, including potential upward adjustments of the default fund in stressed markets, capital assessments beyond the default fund, and perhaps most importantly, the potential need to assume positions from a defaulted member in an auction. Everything about these potential events becomes easier, less risky, and more reliable when members are better capitalized. The paper on incentives to clear also raises the issue of clearing member concentration and its relationship to the cost of clearing, including capital. Excessive concentration of clearing services can also contribute to systemic risk. But we should be seeking ways to increase the number and diversity of FCMs offering client clearing without increasing the overall leverage in the system. Given the dominance and significance of a small number of large bank FCMs, we should especially not be taking steps that could reduce the capitalization of these institutions. Instead, we should be ensuring that they are as strong and solvent as possible. One way to do this might be by targeting capital requirements that do not affect smaller institutions in the same way, such as, for example, the GSIB surcharge and its relationship to clearing volumes. To move on to the paper on clearinghouse resolution, this paper was full of tactical details, but I wish that it had taken a more strategic approach to examining possible contradictions within the three stated goals of CCP resolution. And I'm talking about the goals of CCP resolution in the BIS resolution guidance. Those goals are maintaining CCP function, protecting taxpayers, and maintaining financial stability. In a situation where CCP recovery efforts have failed, probably failed multiple times, with a resulting loss of market confidence in the CCP, these objectives may come into conflict and raise difficult questions for regulators. It would be beneficial to make answers to those questions clear in advance. Reading between the lines, the resolution paper also implies that it will be challenging to actually use CCP equity to absorb losses in a highly stressed resolution-type situation. For one thing, we can expect that that CCP equity won't be highly valued in the market in that situation. There would therefore be significant advantages to pre-funding such skin in the game through retained earnings during good times when CCP valuations are high. And not to pick on CME, but I just took a look at CME with a market capitalization of $65 billion, appears to pay about 80 to 90% of its operating income out to shareholders. That's about $2 billion a year. CME's default fund currently stands at $8.3 billion. Over multiple years, it seems that retained earnings could make a meaningful contribution to the default fund while still permitting strong levels of dividends as a fraction of operating income. My final thought is not directly addressed in the papers we're reviewing, but it seems to me critical in all of them, and that's regulatory stress testing. Initial margin will always be the most important element of loss absorption in a true systemic risk situation. If cleared margin is set in a truly robust and countercyclical manner, many other questions will be much less pressing. It did concern me that we heard prominent clearing members in this morning's panel and our last meeting raise some questions about CCP margin model calibration. Regulatory stress testing should be a key mechanism for ensuring that we get margin right. As we all know, the CFTC is under-resourced, and within those resource limitations, staff have been doing a great job standing up the operational capacity to stress test CCPs. Now that we have that capacity and several years of experience in running stress tests, we should think about how to use these tests to explore a greater and more challenging range of stress scenarios. CFTC tests so far have found adequate resources, but there's a growing outside academic literature that raises concerns about issues ranging from a breakdown in correlation assumptions to network effects on losses. The CFTC should work to incorporate these concerns in future stress tests and should also engage with clearing members to ensure that member concerns about margin models are addressed. And as one final note on stress testing, the FSB paper on CCP resolution calls for identifying potential loss scenarios in advance that may lead to resolution. And this seems to me to suggest a potential role for reverse stress testing to try to identify those scenarios. Thanks very much.
Thank you, Marcus. Apologies. And now we'll have Robert Wasserman, Chief Counsel, Division of Clearing and Risk, and he'll talk about the BCBS consultative document, as well as the prudential rules, as well as the FSB adequate resources and resolution and treatment of CCP equity and resolution.
Thank you. So I'd like as well to thank Commissioner Benham and Alicia for inviting me to be here. Also need to give my usual disclaimer, which is to say that the views I express are not necessarily those of the Commission or of the staff, or even of myself if I'm directed to change them by competent authority. So I think I'm going to start with the FSB paper, and I think it's important to have some historical context. So last July, in 2017, the FSB issued final guidance on CCP resolution and resolution planning. And that guidance covered topics including objectives of CCP resolution and resolution planning, resolution authority and powers, resolvability and resolvability assessments, standards for entry into resolution, the concept of no creditor worse off. And so in fairness, the guidance that I'm going to talk about that's this year is basically covering a number of topics that were not addressed, but they're essentially much of the scope was really taken care of back in 2017. The two topics that are being addressed currently are, as has been noted, financial resources to support CCP resolution and treatment of CCP equity in resolution. And the paper was issued on November 15th. Comments are due by February 1st. And indeed, as well, there's going to be an industry forum in Basel in January. In Madrid, rather, in January. Now, the paper covers financial resources through a 5-step analytical process. And it's pretty logical in the sense that it's looking at identifying hypothetical default and non-default resolution scenarios. And I should note, this is not going to be specific to, well, what happens if this happens to the oil market or some other market. It's rather looking at, well, given especially the standards that are already there in the PFMI, how might we actually get into resolution given the availability of recovery tools? Then you need to evaluate the existing tools and resources. And these include, and with apologies, assessments, gains-based haircutting, partial tear-up, and other powers of a resolution authority. And of course, in the case of non-default losses, which were discussed on the last panel, these include things like the CCP equity, insurance, and in some cases, allocation pursuant to a CCP rule. Next step, you got to look at the full resolution costs. And that includes, obviously, both essentially the sort of operational, but as well the substantive costs. And then the next logical step is to compare the tools and resources to the costs and identify the gaps. Finally, consider the availability, costs, and benefits of potential means of addressing those gaps. And so that's sort of the analytical process that is described in the paper. And so, again, there's comments on that. As well, there's the questions of treatment of equity. The guidance focuses on potential mechanisms for adjusting treatment of CCP equity in resolution, but it also recognizes that there are some very important challenges and constraints. One of the most important of those is no creditor worse off. And so, in other words, to the extent that equity is not subject to loss in an insolvency because of the CCP rules, which are the contract between the CCP and its members, then you would have problems both under the international standards and frankly as well under US law, Dodd-Frank, if you were to assign losses to the equity holders that they would not be subject to in the alternative counterfactual of insolvency. And another challenge as well, which again we have here in the US, is the extent to which there may be a lack of authority under the statute in this to impose those losses. As well, the paper asks folks to consider policy issues, including the incentives of CCP management to pursue sound risk management and the incentives of clearing members to support recovery. Also important to consider the historical context of the leverage ratio issues. And so I should note that back in 2012, gosh, feels like ancient history now, the Basel Committee realized that exposures to CCPs carried risks and that those risks needed to be assigned a risk weight. They first implemented an interim approach to recognizing those risks, and then convened a joint working group with participation from BCBS, CPMI, or actually its predecessor, and IOSCO. And I actually co-chaired that group on behalf of CPMI and IOSCO. In 2014, that joint working group completed its work, and the BCBS promulgated risk-based capital charges for bank exposures to CCPs. And those charges include trade exposures as well as default funds, and include consideration of, as part of that process, included consideration of assessments. These have been implemented, and so far as I know, no one is pushing to change them. However, BCBS has more recently promulgated capital charges based on the leverage ratio. This is, by intent and design, a non-risk-based backstop to risk-based capital charges. And calculations for the leverage ratio, again, by tradition and design, do not include recognition of collateral. So indeed, the most important and effective risk mitigant that we have, liquid collateral in the hands of the CCP and the clearing member, no recognition at all, and that indeed has been the problem. And they are ignoring this liquid collateral that the CCP rules require FCMs to collect, and that Commission regulations require them to segregate. This has had, unsurprisingly, a negative effect on banks' FCM's willingness to take on or continue customer business. And a lot of those problems have been discussed by Commissioner Berkowitz earlier, as well as by Saeed and his group. Problem is, unlike broker-dealer rather than FCM capital requirements, which focus on the legal entity, bank capital requirements are calculated at the holding company level. And the actual impact of the leverage ratio at the holding company level is actually fairly small. But at the business unit level, it can be much larger indeed. And with all due credit to my friends and colleagues at the Basel Committee, their incentives work. Banks and bank holding companies, including FCMs, take into account the leverage ratio and they apply it at the business unit level. And that application at the business unit level is what causes a lot of the problems. Thanks, I think, in part to both a sort of a drumbeat that's been continuing for a number of years, and especially as well the good work that Saeed and his colleagues did. There have been what I've been referring to as recent green shoots of hope, both at the Basel Committee level, a targeted consultative document, and among the U.S. prudential regulators. And so Basel issued a consultation in October for comment by January 16th. They are considering, I quote, a targeted and limited revision of the leverage ratio exposure measure with regard to the treatment of client-cleared derivatives only. And I will say, I think part of their concern is, given their reluctance to recognize collateral, I think they really need to be assured that this exception is not going to, in fact, be a breach in the wall that knocks the wall down. They warn that absent a strong evidence-based case to revise the treatment, the committee will retain the existing treatment. And so it is definitely not time to begin celebration yet. There is work to be done. They are considering recognizing collateral consistent with SOCR, the standardized approach to counterparty credit risk, which is to say allowing an offset that asymptotes at leaving 5% of the exposure remaining. And that is, again, consistent with the risk-based approach. They have inquired into how to impose segregation criteria so as to ensure that initial margin, quote, will be available in the event of a client's defaults. Those criteria could specify limitations on the permitted uses by clearing member banks of initial margin received from clients. Banks that currently offer derivatives client clearing services are welcome to share details of the segregation criteria to which they currently adhere and insights into the effectiveness of those criteria to safeguard the amount of initial margin provided by clients in the event of default. Similarly, the U.S. prudential regulators have, in the context of looking at soccer, published a proposal that, among other things, invites comment on the recognition of collateral provided by clearing member client banking organizations in connection with a cleared transaction for purposes of the soccer methodology. What are the pros and cons of recognizing such collateral? Commenters should provide data regarding how alternative approaches regarding the treatment of collateral would affect the cost of clearing services, as well as provide data regarding how such approaches would affect leverage capital allocation for that activity. So on the one hand, I think substantial progress has been made in that essentially the door is at least partially open. And for those of us who look at things from a legal perspective, asking a question in a proposal means that answers to that question could be part of the logical outgrowth of that proposal. But I think it's very important, and I urge industry folks to think very carefully about how they react to these. You guys, the industry folks, are obviously the best judges of their own interests in doing this. That said, as someone who has a professional interest in appropriate capital treatment for exposures to CCP, and again, looking at the important impact on the availability of clearing and the resilience of the clearing ecosystem, I would urge folks to treat these opportunities as an opportunity to be nurtured. You might well benefit by submitting responses that demonstrate a willingness to engage on the concerns that the Basel folks and the prudential regulators have raised, such as the segregation criteria and why they are effective, and the very limited scope of impact on holding company level leverage requirements. I think you should also carefully endeavor to demonstrate the impact of the leverage ratio on the costs and availability of client clearing. And I know from Saeed's experience that that can be very difficult, but again, this is what they're calling for, and this is, I think, what the opportunity is. I'd like to just take a brief moment to react to some of the concerns raised earlier that have relation to some of this. I very much agree with the concerns folks have raised concerning effective and well-designed margin models. I would note that both the international standards and our regulations impose discipline on this process through backtesting requirements. And I would also note that our regulations impose margin-based and thus risk-based capital requirements on FCMs. That said, there are a number of exposures, including in recovery, but at least for the past couple of years, I am not aware of anyone who's focusing on forced allocation. And so having clearing members being forced to take on positions is something that I think may not be as much of an issue now, albeit partial tear-up has some very difficult effects on folks who might be visited upon. I also agree that stress testing is a critical part of risk management. Part of that is supervisory stress testing, and my colleagues, including Saeed and his group, have done and are doing some very important and good work in that area. Of course, those cross-CCP stress tests can, as a practical matter, only cover a limited scope of scenarios. Stress testing at the DCO level should cover a broader scope of scenarios, appropriate in each case to the business of that DCO. I will quote from the guidance issued last summer by CPMI and IOSCO in this regard, that a CCP should complement stress scenarios based on historical data with stress tests based on a full spectrum of forward-looking scenarios. These scenarios should aim to capture stress events that are plausible but have not occurred previously. And the development of forward-looking scenarios should be informed by the judgment of subject matter experts from within the CCP or the participant community, and these experts should have knowledge of the underlying markets, including the relevant economic, physical, environmental, or geopolitical factors. In short, a simple statistical approach, I think, is not enough. If you're going to be developing scenarios, you got to involve folks who understand the markets. Last month, we celebrated the centennial of the end of World War I. And that reminds me of the Maginot Line, which was built by the French based on the lessons learned from that war, and was impervious to most forms of attack. In World War II, The Germans simply went around that line through Belgium. Basing your defenses only on an ability to fight the last war just doesn't end well. Thank you.
Thank you, Bob. And now I'd like to open it up to the MRAC for questions. Oh, I'm sorry. Jim Shanahan, CoBank.
Thanks. And I really appreciate you guys looking at this. I wanted to relate to you guys, the consolidation in the FCM market as end users, and I'll give you a little feedback on cost too. That the farm credit banks, as we've looked to add FCMs and get backup FCMs, is becoming really increasingly difficult to negotiate agreements that we feel meet the criteria that we have, and we've actually begun really working together to try and use our market power to kind of put those kind of agreements in. It's also really tough when you have long-term one-way exposure on your books to get much limit, especially if you're looking at possibly porting any transactions or even going to another CCP. And I'll tell you also, in related to cost, you can negotiate an agreement and then have somebody come back a couple months later with a significant cost increase or minimum fees, which you have to deal with. And as the farm credit banks, we have some ways to deal with that. Ask them if they ever want to underwrite debt again or something like that. And we've been able to work around that. But some of our members who have tried to explore avenues of clearing based on a more voluntary, on a cost basis, have really hit a stone wall. And if some of the aspects where they come into a transaction that is a legitimate hedge that they need to put on the books, there's significant impediments to being able to operate in cleared space. And it's just something I know that the commission is concerned about. They've expressed that. But it's actually, a couple of years ago, there were a lot of articles. There hasn't been much written about it lately, but it's actually probably even worse now than it was a couple of years ago. So just want to throw that out as a representation.
Thank you, Jim. Luke Zuberard, Chatham Financial.
Thanks, Alicia. And Chatham would echo your comments, Jim. Certainly, we have financial end-user clients who depend on these markets to hedge risk, who face challenges associated with the costs of clearing. And appreciated the DAT's questions and the consultation with respect to the impediments to clearing for financial end users. National regulators in various jurisdictions have made accommodations for financial end users, non-financial end users, with respect to, in some cases, clearing, in some cases, margin, in some cases, the CVA capital charge, particularly for entities that are outside of what the report referred to as the systemic core of the market. So, for example, non-financial end users globally have been exempted from clearing and margin requirements. In the U.S., we have small banks who are exempt from those requirements. Many in various jurisdictions, financial end users that transact below certain notional thresholds have been exempted. And in Europe, non-financial end user hedges are exempted from the CVA capital requirement applicable to banks. I didn't see in the report criticism by the regulators with respect to these types of accommodations. I'm wondering if it's reasonable to infer that the DAT does not view these accommodations as inconsistent with the financial stability objectives of the G20.
Saeed, would you like to respond to that?
Excuse me. No, we are completely in agreement. I think we try to raise these issues, which is why we try to frame it in the context of the core and the periphery. And we did get into the weeds of CVA. We would have liked to do more. It's just that there wasn't sort of CVA. There are a few people who understand CVA. A lot of us, I don't claim to understand much of it. But we did sort of raise these issues. There is this once again, there is this tension between one of the questions that comes up is, well, there are a lot of small firms. Collectively, if you exempt them from some of these rules, from the requirements, will that be a source of systemic risk? And my counter argument would be, we have great data today. All these trades are reported. They're doing swaps. Even an end user does a trade. There's regulatory reporting that happens. So we ought to be able to sort of do the analysis and do it. So it was end user issues was critical to us, and we tried to highlight it. But one of the challenges with doing these surveys is that end users and smaller firms are not well-oiled machine in terms of providing us feedback that's important for it. But I think I like to believe we sort of did a decent job of highlighting these issues. And there's more work to be done in terms of working with the standard setting bodies and others. I think what we've done is provided the fact that the DAT went with sort of the mixed group that we had, we laid out these things in a systematic manner. Is actually we're opening doors for market participants and others to provide more data and arguments to make the case to the standard setting bodies and others to start reconsidering the standards and rules.
Thank you, Saeed. The chair recognizes Dennis McLaughlin, LCH.
Thank you. I have a question for Bob. You said a lot of things, but one of the things you were talking about was no creditor worse off. So given that the CCP rules books as they are, they will allocate losses to the last drop from a member default, and the only way they can be overridden really is if there's systemic reasons to override the rule book from the resolution authority. So in other words, the greater good can trump. Now my question is, if you look at no creditor worse off, is there any circumstances where that can be trumped by the greater good? Or is it always an inviolate principle?
So, I obviously don't practice law in the UK, so I can't speak to the insolvency law that would be applicable, in LCH's case. I think the point of no creditor worse off is that essentially, and that concept is, by the way, baked into, for instance, Dodd-Frank, as well as the international standards, is that if you're going to do something for the greater good, you should not be doing that at the expense of particular creditors. And so the comparison is to, well, if instead of taking the entity through resolution, you took it through insolvency, how would things end up? Now, my experience in the sort of the bankruptcy context is that arguments as to what people would suffer in the event of insolvency can be very theoretical, and there's all sorts of ways to argue things. But I think the point is that you're comparing it to that counterfactual rather than saying, hey, the greater good compels it, so whoever happens to lose under the greater good, how sad, too bad. The idea is that no, folks who, the resolution authority can do those things, but then folks who lose compared to where they would be in insolvency then have claims.
The chair recognizes Biz Chatterjee, Citigroup.
Thank you, Alicia. Sai, if I could turn to you and go back to the survey. I think the survey did a great job. I think it was, while the responses may not have covered the breadth of the participants, it definitely was, one of the few quantitative surveys we've seen. Going back to the issue in there on incentives to clear, obviously, market participants provided a lot of inputs into the different incentives, counterparty netting, principal, capital efficiency. Were you surprised by the order in which the incentives, showed up? A lot was made about the disincentive of the mandatory margin on non-cleared products and why that's pushing, products into clearing. But it doesn't seem to have appear very prominently high on the rankings. Secondly, if that is truly an incentive in pushing more products into clearing, at what point does that become a systemic risk issue because you're putting non-cleared, non-liquid products into the clearinghouse?
So there was, in terms of the various responses, right? There wasn't anything sort of really surprising, at least on sort of the list of things that you just mentioned. What was very interesting was that we relied on different sources. So till date, what at least I've seen is various forum like MRAC and FIA and other conferences, industry just coming and constantly complaining. And this was the first effort by the official sector to systematically study it. And as we said, there's academic research, there's regulatory data, there is qualitative surveys, and there's the pricing survey, what we call the quantitative survey. And the inputs from all these different sources was pointing in the right direction, which I think was the most important thing, I guess, which gives you the sort of the solid foundation saying we're not being a shill to the industry. This is not just lobbying exercise, but here when you look at evidence coming from so many different places, it's a confirmation that there is an issue here. And the other challenge I think we have had from just this is my interpretation of the approach to rulemaking and others is this was all done to sort of reduce financial stability, but then it was a very one size fits all approach. And I think what we have done is that the work what it shows is that while mandatory clearing is important to sort of to reduce systemic risk, at the margin it's coming at a very high cost. And what we asked some very leading questions on. Somebody has to go and do the analysis. It was we didn't have the bandwidth to do that. Is if we were to sort of give relief to the other firms, for smaller firms, will that actually reduce any sort of gains from systemic risk? The challenge that I think, which is why it comes to this trade-off between financial stability and systemic risk. The concern that I personally have is the issue of the concentration that's happening. And we laid out a lot of these things where we see firms, clearing members, and this is based on responses from clearing members, where the pricing model keeps changing, and the clearing members are actively what you call optimizing the client relationship, meaning you will have firms and clients who lose access to the cleared markets. And if that causes them to stop hedging their risk, because one of the key finding from the study is that there's been a bifurcation of liquidity between cleared and uncleared markets. Liquidity conditions have improved in the cleared markets and likely deteriorated in the uncleared market. It's hard to do the analysis, but that's what we find. So to the extent we are kicking people out because they don't have access to clearing from the cleared markets, and where do they go? Because liquidity has deteriorated in the uncleared market, and if they choose to not hedge their risk, these are things which one is allowed to measure but can't be measured, and which is where I think from a policy perspective we should be focusing on, right? Things which can't be measured but is likely happening, then we should be mindful of the unintended consequences of our reforms. So sorry, long-winded answer to your question, but that's some takeaways, I guess.
Thank you, Saeed. The chair recognizes Stephen Berger, Citadel.
Thank you. Just wanted to make a few observations in reaction to some of the comments and discussion that's just had. First off, I think there was a discussion of the systemic core and the periphery. And I guess my view on that is that you have a network of bilateral counterparty credit exposures, the nodes of which are a handful of too big to fail dealer banks, each of which has, let's say, 1,000 uncleared bilateral relationships. So something is achieved if you apply requirements just to transactions among the largest dealer banks, but when one of them fails, the risk propagates through the thousands of bilateral counterparty relationships they have. So even though each individual end user in isolation obviously presents no systemic risk, you still need to consider the market structure and whether we've reformed it in whole or left parts of it as sources of systemic risk. So then that brings us to kind of looking at, okay, so how far in that dealer to customer portion of the market, what have we achieved to date? We've achieved a lot in the United States. We've achieved, frankly, more than in any other jurisdiction that we can look at in terms of implementing the G20 reforms. But when we look and a lot of praise and respect for the work that was done globally, but I think we also have to be cognizant of the fact that if we look in the dealer-to-customer market outside the United States, there really hasn't been a full implementation of the clearing obligation. Europe is the only jurisdiction that's really made significant progress, but still over 90% of financial counterparties in the EU are still out of the scope of the clearing obligation, and the next phase is supposed to be implemented in June of 2019. But you go beyond Europe, there's clearing obligations have really just been limited to the inter-dealer market, and the global implementation schedule for uncleared margin requirements hasn't hit anybody on the buy side, and it won't until 2019 and 2020, with the exception of one firm. So, the stock-taking exercise, I think there's still a few years of implementation to play out before we really completely understand that. On the kind of uncleared initial margin requirements and whether they're designed to appropriately account for the risk that's posed by uncleared swaps versus serve as a tool to incentivize greater central clearing, I think we do have to appreciate the fact that in the cleared ecosystem, there's daily exchange and variation margin, and fortunately now in the uncleared ecosystem, there's daily exchange and variation margin. In the cleared ecosystem, all market participants on both sides of the trade post initial margin, and in the uncleared ecosystem, we still have a lot of inconsistency. Either neither side posts, one side posts, et cetera. So I think until the uncleared system is brought at least to the same level as the cleared system, it's difficult to kind of argue that there's unduly penalizing the uncleared system. That said, I think it's completely rational to ensure that the margin requirements we do apply to non-centrally cleared swaps are appropriately calibrated. But I still think that same kind of minimum margin discipline with respect to both sides having to post initial margin is important to put both sides on a level playing field. And last comment I would make is that there are concerns, and I think the work that's being done on the leverage ratio is excellent and long overdue, and so I think that should help address access to clearing capacity for clients who need it. But in terms of the supply that I think everyone was hoping would exist, part of the reason that it's not there is we've frankly taken a really long time to implement what people were developing the capacity to support. And so if you were, I sympathize, I guess, with an FCM that in 2009 was like, I better build a client clearing business. There's going to be a lot of client clearing demand in the next year or two. And 9 years later, there's only one jurisdiction that's really implemented a clearing mandate in the dealer-to-customer market. So I assume after the 2-year check-in and the 4-year check-in and the 6-year check-in with business management, they were told to cancel their business plans. And so I think that's a lesson that says that like delays and exemptions, however well-intentioned and however much they're given to sympathetic petitioners, can actually undermine the overall objectives that we're trying to achieve in terms of moving a critical mass of liquidity in the OTC derivatives markets into a more clear, transparent ecosystem.
Thank you. Is there anyone on the phone that has any questions or comments? Well, Marcus.
No, not from me.
Thank you. Marcus Stanley, we'll give you the last word.
I guess I just wanted to say a short thing in response to what Luke was saying. I mean, I think that we should remember, in addition to the complexities of the network that we've built up, that Stephen Berger just talked about, there's actually a long history of financial crises caused by sort of mass failures in smaller entities, the S&L crisis, the Great Depression, and the difficulty of, I don't think we should rely on just the data monitoring capacities of the regulatory system as they stand now to tell us whether systemic risk is building up among those networks of smaller entities. There's already quite a number of exemptions in place, and I think multiplying them too much could be dangerous.
Thank you, Marcus. Well, that concludes panel 3. Many thanks to our speakers. And at this time, we'll take a 5-minute break so we can set up for the next panel. Thank you. Can everyone please take their seats? What time is it? Okay, the meeting is called back to order, and now we'll have the last panel of the day, oversight of third-party service providers and vendor risk management. Annette Hunter of the Federal Home Loan Bank of Atlanta is the facilitator of this panel. Annette?
So thank you. Can you hear me? Okay, because I've heard there's a little bit of trouble of hearing today. So thank you for Alicia and Commissioner Benham, got that, for allowing me to facilitate this discussion today on the oversight of third-party service providers and vendor risk management. My name is Annette Hunter, and I manage the mid and back office functions for Federal Home Loan Bank of Atlanta. Federal Home Loan Bank of Atlanta is a GSC, and we're regulated by the Federal Housing Finance Agency. And before, I'm going to do a little plug for the Federal Home Loan Banks. We just issued $2 billion in SOFR debt in November. And we've done, he's not here. We're in Atlanta, and we are educating our members and our, the community banks. So just a little plug there. Back to vendor risk management. So we've been included in the discussions with our regulator when forming our risk-based approach to vendor management. So over the last few years, the banks has taken a bit risk-based approach to vendor management. The focus has been on strategy, inherent risk of selecting a vendor, due diligence, contract negotiations and review, ongoing monitoring, contingency planning, and documenting all of this. It's important for all financial market participants to have this kind of approach or a similar approach. I made the assumption when I was getting ready for this that everybody did. And then I kind of learned the hard way that not everybody does. So I'm happy to facilitate this discussion, and I look forward to learning how we can improve our processes at the bank. Ultimately, the goal of the conversation is to consider whether the CFTC adequately sets standards and guidance for its registrants to follow when they engage in third-party vendors. So I've been asked to frame this challenge. So I'm only going to focus on a couple areas, though I'm sure there's many more areas, and feel free to jump in with those with your questions or your presentations. So managing the relationship and accountability. So each organization is expected to serve their customer and manage their core business, no matter what the challenge. We were challenged with SOFR. We worked with our vendors to make sure that happened. But what happens when your major service provider has an issue and your systems go down? Are they accountable? Have you kept your vendor accountable? Have you formed relationships? It takes a lot of resources to form those relationships with your vendors because you want a quick resolution. Should a third party or fourth party vendor be required to provide a business continuity plan? I would like that. So should there be different requirements on critical versus non-critical services? We think there should, but I'm curious of what everybody else thinks. The other area is emerging technologies like cybersecurity and blockchain, or not cybersecurity, cloud, which kind of means cybersecurity sometimes. Cloud and blockchain. What are some of the challenges and risks with that? What are the issues for resiliency in the event of a cyber issue? As I said, I'm sure there's many other challenges we can bring up, but I'm happy to introduce the panelists now. Lazaro, how you say your last name? Director of Governance and Operational Risk Policy for the Office of Comptroller of the Currency. You like to present?
Lázaro, can you?
The trick to saying the name is buy a better radio, should say it really fast. Thank you for the opportunity to address the committee today. I'd like to address or discuss the OCC's guidance on third-party risk management. Banks continue to increase the number and complexity of relationships with both foreign and domestic third parties, such as outsourcing entire bank functions to third parties, such as tax, legal, audit, information technology, operations, basically the entire back office. Outsourcing lines of businesses of products, relying on a single third party to perform multiple activities to such an extent that the third party becomes an integral component of the bank's operations. Working with third parties that engage directly with customers to the point where the customer doesn't know if they're dealing with the bank or the third party. Contracting with third parties that subcontract activities to other foreign or domestic providers. We don't know who's providing the services at the end of the day. Contracting with geographically concentrated firms. Working with a third party to address deficiencies in bank operations or compliance, where the third party is actually providing assurances that the bank is in compliance with laws and regulations. As you can imagine, the number of third-party relationships can easily number into the thousands for any one bank. This is a complex process that requires clear management. These third-party arrangements, if not done correctly, can impact the safety and soundness of an institution. The OCC came out with Bulletin 2013-29 to address risk management expectations for the banks and provide guidance to the examiners. We also asked examiners and banks to refer to OCC Bulletin 2017-43, new modified or expanded bank products and services, bank risk management principles. This one provides a flavor if you're coming up with new products or services, some of the things you should consider. We expect banks to develop risk management processes commensurate with the level of risk and complexity of its third-party relationships. The smaller institutions obviously don't need to develop a great and elaborate process as much as we would expect of the larger institutions. They have much more complexity and integral operations with some of their third-party providers. A bank should ensure comprehensive risk management and oversight of third-party relationships involving critical activities. I should say for all third parties, but those that provide critical activities require much more oversight and due diligence. An effective risk management process throughout the life cycle of the relationship includes planning, due diligence, and third-party selection, contract negotiations, ongoing monitoring, and termination of the agreement. And our guidance goes into great detail as to what we mean by all those. So I won't go into any detail here. The risk management program needs to consider outsourcing should result in a strategic benefit to the bank. The more strategically aligned the services being provided, the more critical the third party becomes to the institution. Management should have effective change management processes to allow for the third party to function appropriately. Clear roles and responsibilities for overseeing and managing the relationship and the risk management process needs to be established. We expect board oversight, we expect policies and procedures, we expect a proper framework for overseeing the complexities that come from working with third parties. And there is no one way of doing it. Some banks have very structured, centralized processes for monitoring the relationships. Others are very decentralized. It's the ones that I find that are the better ones are the ones where it's holistically part of the culture of that institution to be able to say, okay, these are our service providers. How can we monitor it? And it goes all the way from the board down to the lowest rank of the organization to be able to say, have a voice in how well that relationship is working. Again, the more critical relationship, the more oversight required. Third-party relations work best when the cultures are aligned, making sure that the third parties have the same cultural expectations and norms as the institution, the bank. We do expect good documentation to support the decisions that are being made throughout the life cycle of the process, as well as in the selection of in the contract and everything else. We do expect to have good ways of tracking those decisions. We also expect banks to have independent review, and by that I mean have that process audited periodically to make sure that it's functioning appropriately. And we have other guidance that may be applicable. The FFIEC has a great deal on the IT side, and we have other guidance such as model risk management, which I'll flash on the screen later. I think the key to good governance, too, is making sure that everybody is at the table at the same time. This is not something that can be delegated to one person to make the decision for the institution. You need to look at this holistically across the enterprise and make sure that all the divisions are represented, and make sure that the selection is reflective of the needs and the issues that are being seen at the organization. Those that have the compliance, the audit, the credit, the liquidity personnel at the same table making that decision typically make a better decision than those that are just relying on one person or one committee. So anyway, those are just some of the key points that I just wanted to make. And I also wanted to let you know the various issuances that we have. We have specific guidance on third-party risk management. We have the circulars, I said. We also have FAQs on the subject, and we have provided examiners with examination procedures. We also have guidance on new product services and development, a model risk management, which touches on third parties, and also our corporate and risk governance book, the Comptroller series, talks greatly about risk management and how to develop proper risk management programs. Thank you.
Thank you, Lazaro. Next, we'll hear from Julie Moore, Deputy Director, Examinations, Division of Clearing and Risk for the CFTC.
Good afternoon. As Annette just said, I'm Julie Moore. I'm the Deputy Director in charge of the examinations program for derivatives clearing organizations, including those clearinghouses that have been declared systemically important by the Financial Stability Oversight Council. But I must start with the normal disclaimer. The views that I express this afternoon are my views, and they do not necessarily reflect the views of the Commission or the staff. I want to first thank Commissioner Benham and Alicia for this invitation to discuss this very important risk management topic. The discussion is timely, as incidents that result in highly publicized events are numerous. We have all read stories about malware attacks or other types of attacks on software or hardware produced by third-party vendors, where credit card information or other sensitive documents have been taken. DCOs work with sensitive information in order to complete their required activities, and as a result, we have an examination program that focuses on DCO's vendor risk management. DCR's program is built around CFTC regulations and industry best practices. Our regulations state that a DCO must establish and maintain resources that allow for the fulfillment of each obligation and responsibility of the DCO in the processing, clearing, and settlement of transactions, and that the DCO must maintain resources necessary to complete its obligations using either its employees and its own property or through written contractual arrangements with other DCOs or other service providers. A DCO that enters into a contractual outsourcing arrangement must retain responsibility for any failure to meet its obligations. And lastly, the DCO must have personnel with the expertise necessary to enable it to supervise the delivery of services by a service provider. For all items underneath Regulation 3918, and that's our System Safeguard Regulation, the standards for the DCO's program of risk analysis and oversight with respect to its operations and automated systems shall follow generally accepted standards and industry best practices as it relates to the development, operation, reliability, security, and capacity of its automated systems. The generally accepted standards and industry best practices that we typically look to include NIST, FFIEC, ISO, and COBIT, but these are just a few. Prior to initiating an examination, we perform a risk assessment to identify those arrangements that we may want to examine. Perhaps we would like to review the arrangements for vendors who provide IT independent IT security assurance services such as pen testing or controls testing. Maybe we would like to review the arrangements for vendors who provide IT services such as software development or data center services. We may even want to take a look at arrangements for vendors who provide settlement services or margin modeling services. Once we have risk ranked the vendor arrangements we would like to include in our scope, we would then take a look at which relationships contain the highest risk. Those high-risk relationships are likely to be those that we would examine. We request documentation that may include one or more of the following items: the policies or procedures that describe its vendor risk management program, any assessments regarding the independence of vendors. We want to make sure that the person that is looking at that's being hired to look at a particular item is not involved in the design or the development or the maintenance of the particular item that's underneath review. We also look at the qualifications of the vendor. We look at the terms of the contract, including all service level agreements. We also look at how the DCO prioritizes the vendors' information security systems, components, and services. In addition, we will look at any reports that reflect whether or not SLAs are being monitored and met. Now, we study these documents before we go on site to meet with middle and upper management who are in charge of the vendor relationships and the management of those relationships. Those sessions help us understand the processes being utilized, the analysis that's been performed surrounding the vendor, and the performance of the vendor. Our goal is to identify any area within the vendor relationship that has not been adequately reviewed and assessed. Issues that are identified are communicated to the DCO, and the DCO will work on remediation plans to address the deficiency. The DCO will submit remediation plans to DCR, and we will identify those plans in an effort to see if the solution will resolve the issue that was identified. And we will continue to monitor the issue until we have seen complete remediation of the concern. Thank you.
Thank you, Julie. Next, we'll hear from, that's my paper.
Solomon Benai, IHS Market.
Thank you, Alicia, and thank you, Commissioner Benham, for inviting me to speak. I think you guys brought me as the sole third-party vendor for this panel. I can't purport to say that I can speak for all the vendors out there, but what I can present is a view from one of the larger fintech service providers that's out there. To give you a little bit of context in terms of who we are as a firm, so IHS Markit is a $21 billion market cap public company. Of that $21 billion, about 40% of our revenues come from our financial services business. And when you look at our financial services business, it's a wide array of fintech products, many of them relevant for the CFTC's mission, many of them relevant to other asset classes. Thank you. Before I start, I want to create two new terms just for clarification purposes. So the first is direct regulation. So direct regulation is when an entity is under the direct regulatory or supervisory jurisdiction of a particular regulator. And then I want to introduce a more novel term, which is indirect regulation. And this is an instance where an entity is supervised or otherwise scrutinized by a firm that is itself regulated consistent with that firm's regulatory requirements. The reason I bring that up is while some of the services we provide, particularly relevant to the CFTC's mission, are not directly regulated, they are certainly indirectly regulated, and that's an important distinction to make. But stepping back, so what is a fintech? The FSP definition, I think, is a useful one from 2017. Fintech is a technologically enabled financial innovation that could result in new business models, applications, processes, or products with an associated material effect on financial markets and institutions and the provision of financial services. The OCC's third-party risk management guidelines includes some discussion of expectations around vendor risk management associated with fintechs, in addition to other services. So who are we? So this is a subset of the services that come out of IHS Markit Financial Markets. Roughly in order of the number of due diligence inquiries we get from our regulated customers. So there's our post-trade business. It's our loan processing and clearance and settlement business. I'm involved in that effort, as well as our derivatives processing platform, capturing trades, providing a means to confirm those trades, providing connectivity to clearinghouses, and also providing regulatory reporting services. And that's probably the most important service that we provide for the CFTC regulated markets. And then another important set of products that we provide across asset classes is our pricing and valuation services, as well as our reference data business, our indices or benchmarks businesses, and then we have a number of managed services, some of which could be called RegTech, regulatory technology. These include platforms that facilitate compliance with KYC requirements, as well as know your third party, KY3P requirements that our customers are subject to. Just very quickly, we also provide Market Digital, which is website hosting, content provision for including robo-advisory tools for broker-dealer retail customers. So why do firms outsource to fintech companies like us or third-party service providers in general? Lower cost is a big driver. So we can provide scale that an in-house solution just is not capable of. This is particularly true when a particular function is not really a value generating or differentiating function for a particular company. So a lot of times it makes sense, in a sense, to socialize those costs through a fintech service provider like us. We can offer, because we're subject to market discipline, to deliver at a lower cost. We're also subject to market discipline to deliver that product at a higher level of performance and with greater efficiency. And then, of course, there's the opportunity cost of developing an in-house solution for a particular challenge. I don't know why I put this slide in, but this is Google Trends. The term fintech, you can see it really picking up 2014. Actually, I like the term. It's a good shorthand for the ecosystem of financial technology providers. So we've, as a firm that's both, indirectly and directly regulated fintech service provider, it's required us to think, a little bit more deeply about regulation and what it means, what its benefits are, what its costs are, what its impacts are on a particular business. And we've derived, 5 principles that I think generally apply to the oversight of third-party service providers. These could be used by one of our customers that's scrutinizing us, or they could be used as a basis for a regulator trying to formalize their approach to third-party oversight. So the starting point, and this echoes Julie's comments and Lazaro's too. The starting point is documenting. It's very important to document all material relationships, so you can hold both the customer and the third-party service provider accountable for and allocate rights and responsibilities. It's very important to document those, make those explicit. Another principle which is of general application and is a great starting point. I don't think it's an endpoint in all instances. Is that non-discrimination? So, third-party service provider should generally not be subject to less oversight or lower standards than an in-house function. I call this the floor of third-party oversight expectations, and then the ceiling would be third parties should not be subject to more oversight or higher standards than a similar in-house function. There should also be open dialogue. I think the CFTC does a terrific job at this. I can't say the same for all regulators, but there should be open dialogue, and it should be encouraged at all levels, both on the private industry side among the third-party service providers as well as the regulators. From a third-party service provider perspective, it's helpful for us to engage with the regulators so that we can deliver our services in a compliant way and not have to rely solely on our customers. Responsiveness. So I think the CFTC again does a great job here through the TAC, through the MRAC, through at the commission level. Regulators should be responsive and encouraging of new approaches and new technology and not unduly burden commerce and innovation. The basic idea is a regulatory tradition should be a basis for regulating innovation, not a barrier to innovation. And then lastly, this is an important principle for all regulation, is proportionality. So oversight, expectations, regulations should be proportionate to the extent of reliance and the risk associated with a particular service. And under certain circumstances, that may require external validation. For example, external audit of relevant controls. So when does it make sense to directly regulate a fintech? So here, I've really just presented my inferences based on my knowledge of other financial regulators' approaches to regulation and their organic statutes. So one rationale is to ensure that appropriate conduct, that a particular firm is applying the appropriate conduct for a significant fiduciary or customer relationship. Second is to ensure the integrity, operational integrity, or price discovery function of a particular venue. Another is to ensure appropriate risk management for central risk nodes. Another is to mitigate substantial operational risk. Then is to facilitate commerce, for example, to provide legal certainty for businesses that would benefit from it. And then what's the rationale not to regulate? Avoiding barriers to entry, encouraging innovation, competition, and regulation of a particular service would be disproportionate. So CFTC right now has an approach to vendor risk management that I think is a fair balance between all those countervailing principles that I discussed earlier, and it can, it may decide to adopt a new approach. If it does, it can, for example, provide written policy guidance for registrants' management of third-party risk that maybe fleshes out those expectations along the lines of the level of detail that the OCC has provided. It can encourage certifications or external validation. We as a firm, we're set to submit about 6,000 responses to our regulated customers in response to due diligence inquiries that come out of primarily regulators' expectations for those firms this year. And that's coming from 929 firms. And we have a staff of about 10 people whose job it is to provide those responses. It's, I think we're large enough that we see the value of providing these assurances to our customers, but I think a lot of the smaller fintech players, this is a burden and a barrier to entry. From our perspective, we welcome it, but smaller firms may have a different opinion, and I would advise before the CFTC formalizes its approach to vendor risk management that they also engage with some smaller fintech firms as well. And then there's, of course, direct regulation that the CFTC could undertake through its existing authority, as well as direct regulation through new authority, which would probably require legislation. And that concludes my remarks.
Thank you. So I will start the questions, and then hopefully the rest of the members can join in. So because we've got a variety of panelists here, I'm going to ask this. Have you experienced or observed any examples of vendor risk operational losses or incidents, and how were they dealt with?
Well, we see it almost every day. Every time you look at the newspaper, you're seeing something regarding credit cards or a whole litany of things that could happen. Just the other day, yesterday, I guess, Marriott, $500 million, even though it's not a banking institution. And I think one of the biggest threats, or the biggest exposure to some of the banks, is the headline risk that they're seeing that's really very difficult to quantify. How do you put a price tag on that exposure that you're getting? In terms of other exposures, it's one-off. There's nothing really systemic. You just address the issue, try to come up with a loss figure, and then you try to go forward. So I know I'm being very general here. It's difficult to talk about one particular institution, but I don't know if anybody else can add any more insight to that.
I can provide an observation. So we are currently a Conduct 3 firm registered with the FCA. And at the core of our regulatory relationship with the FCA is notifications of whenever we have an operational issue. And we do that periodically. And I think that's a good starting point for firms that play a similar function for us, is to have an open dialogue around operational failures and have a constructive conversation with our regulators. Those events, by the way, don't happen very often. One or, I'd say, more than a few minutes happening 1 or 2 times a year, but it does happen. It happens with all the regulated firms that we connect with as well.
Thank you. Actually, Lassara, did you have something else to say? Okay. Well, I wanted to open it up to the MRAC for any questions or comments on this particular topic. Betty Simpkins, Ohio State?
Oklahoma.
State, I'm sorry.
Yeah. Well, I want to thank Commissioner Benham and Alicia Lewis and the CFTC broadly for holding these important meetings. And as part of the committee, I just want to emphasize that I believe that improvements in risk disclosures are needed in financial statements. I've been doing research for like over 26 years on market risk, enterprise risk management, more recently in energy risk, and cyber risk very recently. Today, we've heard repeatedly many key words and phrases: communications, transparency, skin in the game, good governance, enterprise risk management, cyber risk, best practices, and others. And from my cyber risk research, which includes many firms, but it also includes, broadly, it also includes firms covered by the CFTC. And when I look at the 10K disclosures and the proxy statements, and I was looking at them today when I got at my laptop just to see, in the financial statements from the public perspective, because the public was mentioned several times today, we find boilerplate disclosures that, you know, you would see like the big four accounting firms across them, just they're very generic. And so it concerns me from a public perspective that it's not clear that there's adequate risk management taking place. Let's just take cyber risk, for example. Yet we've had a lot of rich discussion today that yes, there is, there appears to be. When my research, more recent that I'm looking at, is after a cyber breach, we look at the risk disclosures before and we look at them after. And even after the cyber risk, there's some companies it's totally missing that they're doing anything to address it. And even some of these companies are, you know, under the oversight of the CFTC. And so the follow-up's not there. And, you know, I think I like the idea of best practices encouraged, you know, by the CFTC. I'm not here to propose more regulation. Like it was mentioned earlier, if self-regulation could hopefully be done just to make improvements in this area. And so those are just some broad comments I wanted to make. Thank you.
Thank you, Betty. Commissioner?
I'm interested to know, and this kind of goes back to the non-default loss conversation from the members, if you're willing to share or participate, to the extent that do you believe, and I understand that each and every enterprise, organization, or franchise has its own vested interest in protecting its third-party vendor relationships. I think that sort of statement can be broad and apply to most of the sort of risk management that you all do. But from our perspective, and Chairman and I have spoken about this, you know, and Julie mentioned, we specifically have Julie here from DCR because DCR does have some sort of element of third-party vendor relationship guidance, which she's pointed out. But there are pockets within the CFTC's overarching rules and regulations where we do think we should, at least I do, because I can't say, I got to take the we back. I think that this is a conversation worth having because there may be pockets that I believe the Commission should step in and think about as technology advances and changes and evolves on a daily basis. So from a market participant standpoint, again, if anyone's willing to share, going back to the non-default loss conversation, do you think existing rules, guidance, or principles that may already exist from any number of banking regulators or oversight regulators is appropriate, or do you think there is room for improvement and growth in that space given how much the market's changing? And then I guess, you know, more specific to the CFTC, do you feel more third-party vendor management guidance, principles, or rules should be appropriate or thought about in the future?
Salman Benai, IHS Markit.
So we think, speaking for IHS Markit, we're under adequate scrutiny from our regulators and from our customers. As I mentioned, 6,000 responses this year. We also, I didn't mention, we also provide our customers that ask for it the results of an external audit we conduct every year that looks into our controls and ensures our operational performance in line with our customers' operational requirements. So we think, market discipline with the reinforcement of banking regulators in particular, providing additional reinforcement is adequate. But if we would not be opposed to a more direct, supervision from a market regulator like the CFTC, so long as the principles that I described earlier are more or less followed, particularly the one around proportionality.
Thank you, Salman. Craig Messenger, Virtu Financial.
Commissioner Benham, I think the way I'd answer your question is guidance, definitely. Regulation's tricky because you need to be careful that regulation doesn't hamper innovation. And I think what's going on in the marketplace in many cases is, first of all, the laws as it relates to data and privacy are not really granular right now. They're not well understood. They're being interpreted differently around the world, which creates an interesting challenge. You can go to a country like Singapore where it's very prescriptive. And then you can go to a country like the United States where it isn't as much so, and innovation is happening a lot. So my feeling is that best practices and guidance is always good. Just be careful with where we trip into the regulatory side. The other thing is market structure is changing across every asset class. And, you know, many times you feel like people are trying to equitize, for example, fixed income, and the product just doesn't fit there as well. So I think we just need to be very careful as we approach these different markets.
Thank you, Craig. Frank Hayden, Calpine Corporation.
Yeah, I would like to thank the Commission for hosting this discussion on this very important topic. Thank you. So tying into this non-default loss concept and this idea of a first loss, I mean, from my perspective, if it's your job that you failed at, you should eat that loss. And so from the vendor relationship, if it relates to late trades, fat fingers, you know, not being able to model a deal, not being able to put stuff in, absolutely they should eat that problem. I mean, that's their problem, right? If it relates to something more systemic, like, you know, there's a denial of service attack, or there's some sort of, you know, massive hack going on and the systems go down, it's a different problem in nature. And so I think it's important when you start thinking about the various risks the vendors face that you break up the various buckets of that. So some operational risks are strictly related to what I would call incompetence. Like they can't value a deal. They take 2 days to run a Monte Carlo because it gets hung up because they can't figure out how to do a correlation matrix, right? Or they can't input a new product. A trader comes, hey, I want to trade something new, and they can't figure out how to put it into the system, and it just sits there in a drawer. The market moves, and then when it shows up, there's like, you know, millions of dollars out of market because of that, and, you know, inability to track a transaction, right? So I think that there's certain things that definitively fall on the vendor that the vendor needs to be better at doing and better in delivering. And then on the other hand, I think there's other things that just really come down to the company who hired the vendor just being incompetent in their processes. And from that perspective, you know, that's, you know, easy bait for a first loss in my view on the NDL stuff.
Are there any members on the phone with questions or comments? Salman Benai, IHS Markit.
Yeah, I just want to echo the gentleman from Calpine's comments and emphasize an important point, which is any vendor, any fintech vendor, any other vendor operates in a free market, operates subject to market discipline. So if they don't deliver in a way that their customers expect, they go out of business. That's an important point, I think, to make as the CFTC thinks about whether new guidance or new policy in this area is necessary, because market discipline is, you know, regulates all markets and, you know, more or less does a fairly good job in certain circumstances. In other circumstances, you know, it does require regulatory intervention, and that's up to the CFTC to decide.
Quick question for the CCPs and trading platforms in the room with respect to concentration risk. You know, a vendor that is used by the CCP is also used by a clearing member. What are your thoughts on concentration risk? Oh, I have a taker. Derek Kleinbauer.
Thank you. I would say, as a CEF, we certainly, you know, we have an obligation to get a trade from the execution point down to the clearinghouse. And while not necessarily focusing on concentration risk, I will say we are required to use the platforms and services that our participants elect to use, and we have a responsibility to support that. What I will say is to get from point A to point B, we're providing that service, but we also have several external touch points that we're going to as a result of the customer's choice. So while we're under the you know, scrutiny of getting that trade to the destination, whether it's the CCP and then following that the SDR, we would hope that any services that we leverage on behalf of our customers also faces the same level of scrutiny and oversight. because it is part of that workflow.
Biz Chatterjee, Citigroup.
Thank you, Alicia. I think I just want to build on your question. I think the importance of, understanding vendor concentration is important between CCP and clients. I think it's also important across the CCP ecosystem. The same vendor may be servicing multiple clients. So to the extent you have either a temporary outage or a multi-day outage in a vendor, I think it's very important for this committee and maybe the division to look at where those concentration or blocks exist in the entire clearing scenario.
Thank you, Biz. Dale Michaels, OCC.
Yeah, that is one thing that we look at as far as the concentration. We look on the future side. There are basically two back office vendors, one of them which has the majority of the business. And you have to look at that and make sure that they have the business continuity in place, that they have the operations, that they have additional staffing. On the security side, there's basically one large facilities management business, if you want to go into that realm. Again, where on our standpoint, we have to look at, again, their business continuity, their staffing, look at what they have as far as plans, and look at the actual sites that they have. So it does put an extra onus on, I think, not only the CCPs, but the clearing members to do their due diligence all around, because we all know who we're speaking about here, to make sure that because there is this concentration and it has evolved over the years to this select few, and we're not going to get away from it. We just have to be very proactive to understand it and then to try to mitigate as best as we can.
Well, a follow-up question to that. Would it be beneficial to have minimum standards or guidelines in terms of how to manage that relationship from the CFTC?
I don't know if it's the guidelines for this one is needed. I kind of go back to Craig's point earlier, is guidelines are always welcome. I mean, I think it's welcome to talk about it with the whole community so that we're knowing what the clearing members are doing. CFTC understands what they're doing, CCPs. I think that communication is important. I get a little bit, Larry, when you get into where do you take the guidelines into regulatory prescriptions, because I don't think we want to say, well, we have to have so many different vendors. And it evolved in this direction for a reason. It's a business that it's maybe not as attractive for a lot of folks to be in it because it does require scale, and that type of scale is only can only fit for one or two members.
Thank you, Dale. Dimitri Carousos, Nodal Exchange.
Thanks, Alicia. Just to address your question from our perspective, it's a complicated question because there are lots of services that we use. So I'm thinking of them at least in three different areas. So one is the ISV story that was just discussed. From our perspective, while they have massive market share, the key ISVs in the futures industry, most of the services they provide, we provide redundant services for. So if anything, whether it's pricing positions, trade confirms, whatever, there are multiple ways to ensure that gets to the clearing members and that gets to the participants. So there's no single point of failure that we're concerned about on the key data being communicated to our clearing ecosystem. Another concentration area is where clearing members request that an affiliate acts as their own settlement bank. So that's a key scenario that we have to map out in our recovery and wind down plan. And again, the most I can say there is that obviously there's lots to say about clearing member failures that we all understand. When a settlement bank goes down and they're not providing much in the form of custodial services, but just settlement banking services itself, we have multiple settlement banks to rely on to get through a margin run and proceed. So that one doesn't terrify us as much either. And then the third one is what I'm focused on earlier, which is the concentration that occurs on the custodial side that we wish we had other solutions. So I think I've already addressed that.
Thank you, Dimitri. Lee Betzel, CME.
I'll just add briefly to the points made by Dimitri and Dale that we do have, as part of our obligations, the obligation to identify critical service providers as part of our recovery planning, right? And where we do identify those critical service providers for which concentration may be one of the reasons we identify them, we do hold those to a higher standard. So we perform due diligence on a more detailed and more regular basis than non-critical vendors, just to make that point.
I'm sorry, my mic was not on. And that concludes panel number 4. Many thanks to our speakers. Thank you, Annette, for facilitating. And now we will have closing remarks. Well, we'll start with Chairman Giancarlo.
Thank you, Alicia. Extraordinary hearing today, everybody. A lot of complex and complicated issues that require careful balancing that are all ones of matters of degree, whether it be systemic stability on one hand, market vibrancy on the other, concerns of major market participants or smaller market participants, cleared versus uncleared products, different views on skin in the game, whether from the CCPs or the clearing members or other market participants, issues of market concentration, and as Salman has now coined a phrase, direct regulation, indirect regulation. So a lot of really complex issues. Certainly much more to do for MRAC and for its various subcommittees, and much for the Commission to mull over and think about in the time to come. As Commissioner Benham began in his opening remarks and echoing some points I've made recently, the work of regulation is never one and done. It's an ongoing process. Markets are organic things. They grow, and they change, and they develop, and they evolve. And throughout that evolution, you as market participants and we as market overseers have a constant job to stay up to speed on these changes and to adjust and react and try to stay ahead so that our markets remain as vibrant and yet as systemically sound and stable as we can get them to be. So certainly things are not done 10 years after the financial crisis, or to use Bob Wasserman's colorful analogy, 100 years after the Maginot Line was breached. So things are not done. There's a lot more to do. But fortunately, we have all of the input from all of you, very thoughtful, fact-based, well-informed, intelligent, and really constructive. And so certainly my gratitude, the gratitude of the entire Commission. I know Commissioner Benham will express his gratitude, but our gratitude really for bringing it to these meetings. It really, really helps us. And and I think this is probably will be the last formal meeting of any group this year, certainly the last time the commissioners and I will be here on a dais in front of you as we close out 2018. So wish you all the best, the happiest of holidays. And for those who celebrate Hanukkah, which has already started, happy Hanukkah. And put your seatbelts on. 2019 is going to be a busy year, and we'll look forward to seeing all of you here for more thoughtful consideration of these issues. Thank you.
Thank you, Chairman Giancarlo. Commissioner Benham?
I will be brief. Thanks to all of you for being here. Like I said in my opening remarks, we started with Bitcoin, and then we turned to LIBOR, and now we largely wrapped up with CCP risk management, which it's been a big year. Yeah, and we have a lot ahead of us. Today's conversation was excellent. Reiterating the chairman's points, a lot to unpack, which I will do personally. We'll stay engaged with the committee members if there's things to follow up on. Obviously, the first 3 panels are issues that this committee has discussed extensively, but I don't mean to suggest not enough. We always have to stay on top of these issues, but something that I think is important from a policy making standpoint, we need to convene, we need to discuss important issues, but we also need to produce deliverables. There certainly are a lot of issues that were discussed on the first panel for sure, but also the second and third, which are not easy questions. They've been questions that this commission and all of you have dealt with for many years, and there is a little bit of friction between, I think, in my opinion, our role vis-a-vis the market's role and how that relationship should exist. That said, I think I did hear a few things today, and we'll take them back for the new year and think about if there's a way to dig a little bit deeper and find solutions. I think we have a lot of reasonable people in this room who represent a lot of different organizations across a full spectrum of the industry. And in my mind, a lot of, I think, fair heads can sort of come out on top here, and we can find consensus and some solutions to problems that I think would be small steps towards a safer, better, more resilient market. I want to say a couple more things. On the FCM concentration, we heard it multiple times today, both from folks on this side of the table and around the room. Tough issue for sure, and one that I think personally I've dealt with for a number of years. It is a tough balance where it feels like a zero sum. Marcus, I'm thinking about what you said about capital treatment. Obviously, credit risk methodology is another sort of proposed solution, but I don't think we have any clear idea of how any of these possible ideas will resolve, if at all, this concentration issue. So we all have to be reasonable. We all have to be thoughtful. And even though we might fear a policy decision creating a new risk in a different space, I think the concentration issue is a real problem. It's one I know the chairman's spoken about a lot. I've spoken about it. I spoke about it at Chicago Fed in October. So we need to keep thinking about it because it's a core fundamental part of our market. And we need to provide, John, as you pointed out, our end users, and Luke pointed out, an ability to clear and use our markets for risk management. On this last panel, you know, like I mentioned in my opening remarks, thanks to the three panelists here, a lot to work through, and this is just a starting point. Craig, appreciate your point and the points on follow-up. I understand that I need to be thoughtful about this, and these are only ideas that I'm going to sort of digest and potentially present to the chairman at some point in the future, but there's a lot of work to be done, and I appreciate a principles-based approach as this agency has done for decades, and it's probably the one that best suits the marketplace, both from an innovation standpoint and sort of a best practices standpoint. So I will end with that. Thanks to all the moderators, Robert, Isaac, Alicia, Annette. Thanks to all the members for showing up. Bob Wasserman, thanks for the Wasser cakes, of course. Of course, thank you to the chairman for his work, his attendance, and Commissioners Stump and Berkovitz for their time to be here for most of the afternoon. It's a long day, but we have a lot to look forward in 2019. My general idea, and I know this is always, I don't want to corner myself here, but looking at May and November, so 2 meetings for sure. We won't do more than that, but those seem to be times of the year that we can get folks down in D.C. And spread out enough where we can have thoughtful conversations as we always have. My door is always open. Feel free to reach out. I have a big spreadsheet of ideas that you all proposed. This committee is its members, so we will discuss issues that you care about. And as I and Alicia continue to think about those issues in the next months ahead, we'll start to finalize what the issues will be in 2019. And finally, thanks to Alicia for all of her hard work. Not much else needs to be said about this committee and how it runs so smoothly, and that is in large part, if not all, due to her work. So happy holidays, best of the new year, and look forward to seeing you all very soon. Thanks.
Thank you, Commissioner Benham. I want to thank everyone for attending our third and last MRAC meeting of 2018. Happy holidays. The meeting is now adjourned.